Good morning. I'm Julie Hyman with Brad Smith. This is Yahoo Finance Live, and let's get right to the three things you need to know to start off your morning. First thing you need to know, investors are gearing up for corporate earnings season, with big banks kicking it off later this week. The street's expecting a gloomy quarter, with analysts surveyed by FactSet predicting a nearly 7% slump in profits, and that would mark the worst performance since the COVID-19 pandemic. What does that mean for stocks? Well, April is historically kind to the S&P 500, but analysts are wary on whether the stars will align this time around. Second thing you need to know, PC markets have had a tough start to 2023, with Apple taking the biggest hit. A new report from IDC shows the global shipments of personal computers dropped by 29% in the first quarter, as weak demand and excess inventory continue to have an effect. Apple's shipments dropped over 40% year over year, with Dell just behind at 31%. At the same time, computer chip maker Taiwan Semiconductor posted its first revenue decline in almost 4 years. Overall, IDC expects the PC market to decline even further, but does see recovery next year if the economy improves. And thing number three, Tesla is betting big on the battery industry and on China. The company announced it's going to build a new factory in Shanghai to make more of its Megapack batteries. Those are used to store huge amounts of electricity for commercial projects, not for vehicles. The new factory is going to be able to produce 10,000 of these Megapacks. And Tesla's decision comes as China-U.S. tensions remain high, with China conducting military exercises following House Speaker Kevin McCarthy's meeting with Taiwan's president last week.
Well, corporate earnings season is set to kick off this week, with some of the big banks reporting results this Friday. Goldman Sachs warning that this could be the worst earnings season in years, as companies fight a number of challenges like inflation and rising interest rates. Now, even as we look out to some of the banks that are going to be reporting this week, it was the prior week, last week, that we got the annual shareholder letter from JP Morgan CEO Jamie Dimon, who really kind of teed up what some of the tenor that we may hear from some of the other banks looks like right now, and really saying that right now, yeah, things are still, the economy still healthy. However, that there are still some storm clouds ahead, most notably international tensions, geopolitical tensions he cited, but also the rate of QT, quantitative tightening, that the Fed is still going on its pathway on right now as well.
Yeah, so there are some issues that are specific to the banks, particularly in the wake of the collapse of Silicon Valley Bank and the discussion that bank profitability would potentially be hit by that, some new fees that they're maybe going to incur from the Federal Reserve, of course, some of the outlay that they had to put out in order to try to stem that crisis. And then there's the idea of net interest margin, the difference between the interest that they earn on loans and the interest that they pay out on deposits, and whether we're going to see that squeeze to some extent. Also, whether we're going to see loan growth start to slow. We're going to be talking about that later on in our hours here. So that's specific to the banks. But then there is that overall concern about earnings for S&P 500 companies. Julian Emanuel over at Evercore writing in his morning note, stocks are hitting the wall into this earnings season. And he says results are likely to be a negative catalyst at the index level.
Yeah, that was something that was actually mirrored in terms of the expectations at FactSet as well. For Q1 and Q2 of this year, analysts are actually projecting earnings declines of 6.6% in Q1 and then negative 4.4% as well in terms of the declines in Q2 of this year, and not expecting any type of bounce back until Q3 and Q4, where in Q3 they're looking for earnings growth of 2.3% and then in Q4 9.3% according to FactSet analysts there. So all in, that would give you kind of a net out of earnings growth of 1.5% once everything shakes out by the end of this year as well. And you think about some of the sectors that we should continue to watch, especially coming off of Q4 2022, keep a close eye on materials and communication services. Those were two of the larger kind of, when you think about the earnings that came in above or in line or below estimates, the largest misses were in materials and communication services there. Both on the revenue side and on the earnings side as well there. So keep a close eye on those two particular segments going into this season.
Yeah, and one maybe silver lining of all of this that Goldman Sachs points out, maybe this will be the trough for earnings, and then things will start to improve from here. But we'll see
if
that ends up being the case. One other potentially silver lining, historical trends. If there are any indication, the market could see big gains in the month of April. Joining us now with his thoughts on where the market is headed is Ken Shan, who is FundStrat's head of data science research. Ken, thanks for being here. So April seasonally tends to be good for markets, but you don't necessarily tend to have this kind of an earnings setup going into April either. So where do you think it all shakes out?
Hi, good morning. Yes, we definitely constructive on the market, and the framework we used for the seasonality was we call it the rule of first 5 days, and we basically look at if the market is down in prior year and if the market up more than 1.4% in the first 5 trading sessions of the year, and historically we identified 7 prior instances, which the market on average up more than 25% of the entire year, and this, of course, the past performance doesn't guarantee the future results, but this framework actually plays out very well this year. The model suggests the good performance in January and the pullback in Feb and another big rebound in March. That's actually what happened this year. And if this framework plays out again in April, then we could see market up 3 to 4% this month. And as you guys mentioned, of course, the earning is important, but I think the market is more forward-looking. In other words, a good example would be, over the past 6 months, we have seen consistent downward revision on the earning estimates, but the market has been able to manage to up more than 15%.
Okay.
Another example would be, that last year the earning actually was up, but the market has been down. That's why we in our framework we think the 2024 EPS is actually more important, and a lot of those kind of bad earning already priced in the current price.
What is the data telling you right now about technology specifically as we get into earnings season here? Do you believe that the bounce that we've seen in tech and that trade particularly that's caught some attention is going to stay hot, or is there kind of a dampening of some of the expectations that's still yet to come?
Yeah, we still think we should stick with the Fed. Fed is such a large portion of the overall index. If the index going to be up, then tech has to be up, and tech, given the current the macro backdrop, the high, the low unemployment rate, then Fed is also actually one of the solutions to that. Therefore, Fed still our top pick of the year.
Do you think that some of the tightening of financial conditions that we have seen, though, are going to be problematic for tech? And, even though the Fed might be closer to the end of its rate increase cycle than the beginning, it doesn't seem to be done. Does that mean still a rocky road for tech in the shorter term?
I don't think so, actually. I think it's still as you guys mentioned, like the recent data showing like the inflation is actually falling faster than what the Fed expected, that many people expected, and also the improvement in the labor market, and that's actually showing the Fed has less work to do. And if the Fed pivot or even like stop cutting rate, that's actually benefit the tech. The P could further expand, even if given the current market condition, even if the EPS, even there is a decrease in the E, but a small increase of PE could offset that reduction in earnings, and could still support a tech rally. And
so with the Fed right now specifically, if they even were to pause or even pivot towards cuts in the future too, what would that signal about the economy and what they're specifically seeing in terms of some of the trends and what that actually means for a landing scenario where we've continued to kind of use this analogy of a soft landing versus a hard landing, or even the no landing has been out there, but it sounds like that might be off the table?
Yeah, we're not the FOMC. I don't know what's going to happen in the May FOMC, but I think the most recent data, especially the Friday's job report, the employment report, showing like it's actually a welcome results by the Fed. And it's definitely strengthened the case for a soft landing or even no landing. The unemployment rate is still low, while the average hourly earning has been on the downtrend for a few months. And we also seen the participation rate is ticking up. based on your perspective, you can call it the good or bad results, but I think this is definitely welcome results by the Fed. And while Fed might not necessarily like immediately respond to that, they might say, "Oh, we need more data point to prove blah blah blah." But we don't think it. To me, it doesn't make sense for the Fed to risk the economy in order to bring down the inflation or to improve the labor market faster. Because as you mentioned about the regional bank crisis, it's showing the monetary policy by the Fed already start to bite into the banking system. It really doesn't make sense for the Fed to break the economy in order to break the inflation or the labor market.
Well, and as we discuss all this, a reminder that we get more inflation data this week, right? We get CPI on Wednesday, and so that's going to be really important. As we go into earnings season, do you think the market is going to be paying more attention to sort of inflation data and the economic backdrop, or are they going to be weighting these earnings reports more heavily as we shift towards that season?
I think they both are very important. As I mentioned, I think the actual result might matter less. I think what matters more is the outlook from the management. Especially like for the second half of the year and even for next year. And of course, the CPI, PPI release this month will be also very important because that's the main, I think that will be the main indicator that the Fed will decide what's Fed potential path, especially in the May FOMC. One thing I want to point out is on Wednesday, the Fed will also release the March FOMC meeting minutes. That's actually very interesting to watch, like especially that FOMC meeting is right after the collapse of the SVB. So we could know more insight about how the Fed react to like what they thought about the banking, the overall financial condition back then. And that could help us to predict or kind of foresee what's going to happen in the May.
Ken Sean, who is FundStrat's head of data science research. Thanks so much, Ken, for kicking off the week with us. We really appreciate the time and insights.
Thanks for having me.
Certainly. And it's been a weak start to the year for electronics demand. Total global shipments of PCs slid in the first quarter by 29%, with Apple taking the biggest hit, according to the latest report from IDC. And TSMC reported its first drop in monthly revenue in almost 4 years, blaming weak overall macroeconomic conditions. So two things to really break down there within tech as a whole. I'll start with the former, which is that IDC. And what they particularly were citing was weak demand, excess inventory, worsening macroeconomic climate, and really contributing to the global shipments coming in at 56.9 million, contraction of 29%, as we had mentioned, compared to the similar quarter in 2022 as well. But they did kind of offer this other caveat as well. Perhaps it's a conclusion to the era of COVID-driven demand, at least a temporary return to pre-COVID patterns. So a larger question of what real normalization looks like and how the demand environment will continue to move forward. What companies in that demand environment are best positioned to kind of emerge or maintain their category leader positions or titles. But at the same time, that normalization is something that we're seeing across spending and even a contraction on some of that spending at the corporate level as well right now as they're restructuring some of those costs.
Well, there's a lot of ifs in the normalization, right? They talk about that next year we could see a refresh cycle starting to come back into play, but they say if the economy is trending upwards by then, they expect significant market upside. So that's a big if. The other thing that we have to highlight here is Apple. I mean, everybody got decimated still in the first quarter. I mean, these drops are pretty astounding, even coming from a pretty low level. The 29% overall drop, but 40.5% drop for Apple. Now, keep in mind, of course, Apple's the top of the line in terms of price. So you have to wonder if that's an issue or if people are just hanging on to their Macs longer because they don't want to spend that money as of now, or they just don't need it. Before you might say, okay, here's the new one. Mine's a year old. I want to, maybe it's like a used car. You want to try and drive it a little bit further before you get that update. And then that goes hand in hand with Taiwan Semiconductor, of course, because Apple is a big client of Taiwan Semi. So not surprising then necessarily to see that drop in the TSM numbers. But these guys are hoping that this is the trough, right? Right.
Oh, absolutely. Especially on kind of the two different sides of what's driving that demand, the corporate demand versus the personal demand. And I think some of that personal demand, rather, the personal consumption of some of the electronic devices for anybody that on their own personal purchase bought into one of them in the peak of the pandemic, and if that device is lasting you for longer, then the customer life cycle, particularly right now, has stretched further and further. I know I've data-wise, kind of held my own personal computer since 2017. I still see no need to update it. But of course, there's other great PCs out there. But at the end of the day, it's just a matter of where the PC makers, the manufacturers, are going to sell the consumer enough on some of the new features, the functionality, storage, privacy, speed of the devices as well, and when that particular super cycle starts. And here's a little bit of a tidbit here. By 2024, an aging installed base is going to start coming up for a refresh. That's according to the research vice president for devices and displays at IDC. And if the economy is trending upwards by then, to your if that you were mentioning ago, they expect market upside from consumers.
Yeah, and that Windows 11 might be a catalyst, but not an iOS refresh
Right.
cycle. Meanwhile, I'm looking at both of our phones and just laughing because, we're talking PCs, but...
Don't look at my screen. It's really cracked.
Is it the screen that's cracked, or is it the screen protector?
It's the protector.
Both of us have cracked protectors that we have not bothered to replace.
I have a fresh protector, actually. It's still sitting in the box. Haven't changed it yet.
So inertia is more our issue, I think.
I saved that for a good project, for like a lull.
I see.
Like a Lego set that you just hold on to and you save it for a rainy day.
Let's talk one last thing that we're watching. That's Tesla. It's planning to open a new mega factory in Shanghai. The company announcing in a tweet Sunday night, the Shanghai facility will supplement production of Megapacks at an existing factory in California. That's according to Elon Musk. Megapacks are large batteries that store excess power and supply backup when demand is higher. That helps stabilize power grids. The batteries aren't widely implemented yet, but Tesla has plans to supply Megapacks to a Houston area power grid, an Apple-owned site in California, according to reports. The announcement comes amid escalating tensions between the U.S. and China surrounding tech production, and Taiwan for that matter. We're going to talk more about Tesla's announcement coming up. We'll talk about implications for Taiwan and the latest in relations as well.
Well, many investors are ignoring a slowdown in the economy, fueled in part by the Fed's aggressive rate hikes. We spoke with RSM chief economist Joe Brusuelas on Friday, and here's what he had to say about the next FOMC meeting.
The Fed's going to hike its policy rate by 25 basis points when it meets in May. I think that's the primary takeaway. Look, a 3.5% unemployment rate, pretty much status quo, a strong, albeit cooling job market. This is what you want to see, but it's necessary but not sufficient for the Fed to actually declare, hey, a peak.
You can read all about the rising risk of recession in today's morning brief, written up by Brian Sazi, up now on the Yahoo Finance homepage. For a deeper dive, let's welcome in Victoria Fernandez, who is the Crossmark Global Investments Chief Market Strategist. Victoria, great to have you here with us this morning, and thanks for taking some time. Help us break down some of the recession concerns, what Friday's jobs report in the employment situation really signals that the Fed will have no choice but to do at its next meeting.
Yeah, I don't think the Fed wants to paint themselves into a corner here that says they have no choice. But when you look at the jobs report that came out, I don't think there was enough there to force the Fed to change their mind on what they want to do. They have all come out and said they think they're going to go north of 5%, that they're not done yet. Inflation is not moving fast enough or far enough for them to say that they're done. So when you have a jobs report that comes out that had an upward revision to the prior month, yes, it was a little bit better than expectations in far as what the Fed is looking for. And we're seeing unemployment rate, move a little bit higher. You're seeing some of these elements work through. But again, they're minor moves at this point. The Fed wants to see a lot of changes. And the JOLTS report, even though there was some negative reaction out of the JOLTS report, I think it still told you, look, we still have 9.8 million open jobs out there for people. The quit rate in the service sector was still elevated. So you combine that with your labor report on Friday, and it's telling you it's still a strong labor market. The Fed still has more work to do. So yes, I do think they're going to move 25 basis points at the May meeting. Maybe then take a pause after that. Inflation reports later this week might help us see a better path there.
And Victoria, in your notes following the report and in preparation for this morning, you talk about that odds of recession have gone up versus a few weeks ago. And you also say you don't want to be a bear, but it sounds like from some of your notes that you are one right now, at least for the moment.
Yeah, I am, Julian. Look, nobody likes to be the party pooper that's there, but I kind of feel like that's where I am right now. Yes, we have a strong consumer. And, let's go back to conversations we had 9 months ago, right? Last summer, when everyone was talking about the consumer was going to be crushed. And we said, wait, hold on. Don't underestimate the power of the U.S. consumer. And I think that is what has been the foundation for all of this time. But I'm not sure it's going to be enough with the tightening of the financial conditions that we have seen. The Fed tried to tighten financial conditions on their own for a long time. And it wasn't until about a month ago when we saw SVB collapse and some of the other banks collapse as well, Signature Bank, that the financial conditions actually did start tightening. Lending is down. Lending was down, the last 2 weeks, over $100 billion. So that means M2 money growth is going down and growth is coming down. So I think when you take that, you combine it with a consumer that's still strong, but weakening from where they were before. And we think earnings are going to continue to come down. We don't expect a strong earnings quarter. You put all that together, and I think you're going to get a recession as the Fed continues to raise rates. The one thing that we could see, if the Fed comes out and says, look, we're done. We think we're where we need to be. We're not going to keep pushing until we see inflation get much lower. Then the story could change, but I just don't think that's what's going to happen. On
a relatively diminished, I guess, consumer backdrop, is there any kind of portfolio pivot that you would be making right now?
Yeah, we're not really pivoting at this point in time. Typically, the market doesn't make a bottom before the recession hits. So we still think there's some downside here in this market. Again, it's my bearish viewpoint coming out a little bit, unfortunately, but we think there's still some downside here. And when you have a market that is volatile and that we think is more down than up going forward, at least for the near future, you want to focus on those names that have strong balance sheets, the ones that have good cash flows, that have the pricing power. I think pricing power and margins is going to be a key component in this earnings season. And so we're sticking with some of those value type names or quality names, maybe is a better way to say it, that quality factor. Once we hit the recession, then you can start making that shift to those names that have really been hit hard and that will start to perform better. But at this point, stick with quality.
Okay, so still seeing downside, but does that downside also mean a retest of the Q4 2022 most recent bottom that we had seen?
It could, right? Obviously, I don't have a perfect crystal ball to tell me exactly where we're going, but I think if you get 3 quarters in a row of negative earnings, which is negative earnings growth, which is what is anticipated right now, and you do have positive earnings growth priced in for the second half of this year, I think we're going to see that come down. I think we're going to continue to see the consumer pull back a little bit. You combine all that with the uncertainty from the geopolitical issues we're seeing and lending coming down, then yes, I think we could get back down to those lows. Not 100% am I saying it's going to happen. Our probability of a recession is around 65% right now, up from where we were a month ago. But there's still a probability we could have a soft landing. We just don't think that that's the base case. So yes, we see the market moving lower.
All right, Victoria, thanks so much. Good to catch up with you, even if it's not the best of news for bulls in this market. No worries. We got to tell it like we see it, don't we? Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Great to catch up with you. Coming up, Micron getting a boost after Samsung announced some changes to its chip production. We'll discuss and have the opening bell next. less than 5 minutes to the bell, so let's check in on some movers. We're looking at Micron shares. Now, they're rising after Samsung said it plans to make a meaningful cut to chip production amid the sharp global downturn in semiconductor demand. Why is this positive for Micron? Well, there aren't too many memory chip makers anymore, right? There's Micron, there's Samsung, there's SK Hynix of Korea, and we recently heard from Micron that it was still having some issues, right? Memory, more than any other kind of chip, is kind of a commodity. Right. So if you have one of the biggest three producers saying it is meaningfully cutting production, then that, in theory, is good news for the rest of the chip makers as well. Yeah,
factored into Samsung's guidance, their earnings guidance for the first quarter of 2023, they did offer an update. They're expecting consolidated sales of approximately 63 trillion Korean won. And then you're taking a look at what that equates to in a percentage basis, down by about 19% versus Q1 of last year. And their operating profit, 0.6 trillion Korean won as well. So those are some of the updated figures, but again, that comes on the capacity changes that would go in tandem with that as well, and accounting for that is what really is coming forth in these numbers here. But within the market, more broadly, it's at a time where all of them are trying to either ramp up production, especially here in the U.S., and some of the different efforts that we've seen come forward to bring more infrastructure online, to bring more capacity and production online at a time where you do see a cut like this from Samsung's side. This has still been one of the most exciting kind of sectors to watch early in the year, but for two different reasons. One on capacity and another on what the actual kind of intellectual property and then additionally the geopolitical front, how that will continue to kind of play out among all of these manufacturers, at least in the near term, as more of this capacity is being brought online too. Yeah, definitely. I mean, if you look at the semiconductor index, the Philadelphia Semiconductor Index, or the SOX, it's up about 21% year to date. And it has been the sort of programmable, more advanced semi makers that have been doing better in this environment than, say, the memory chip makers. But nonetheless, this is a positive development for them. There's some analyst commentary around the Samsung decision this morning. Citi saying that it's a huge positive for the industry. KeyBank is saying also it's positive for Micron specifically because it will allow the supply-demand balance to come back to the market more quickly. So all of that seeming to be good for chips this morning, or those kinds of chips in particular. Yeah, you got your White Sox, you got your Red Sox, you got your Chip Sox out there. And so, of course, the Chip Sox, the most favorable for investors to keep track of, at least here on the day and early in 2023, given the action that we had seen in Q1 of 2023. We'll see if some of that persists here now that we're in Q2. So as we get set up for the first trading day of the week, we're looking at futures that are indicating a little bit of a lower open here this morning. Really two big things that investors are focusing on this week. The first is earnings, as we've discussed, bank earnings, although those don't come until later in the week. The second is that inflation data. We also get Fed minutes this week. Inflation data coming on Wednesday, and that's really going to be key. We're looking for CPI to have risen 0.2% month over month last month, a deceleration from 0.4% the prior month, a very welcome deceleration if the numbers come in as expected. And on the front of the consumer, also going to see what the banks are saying, but then additionally, what some of the travel CEOs are saying this week too. Going to get earnings from some airlines, Delta Airlines particularly, and we'll see what they say about that counter-cyclical recovery they've seen in travel. Yeah, most definitely. And we got a home builder ringing the opening bell this morning. Taylor Morrison ringing on this Monday morning here as we get set up for today's session. I was away for a week. I'm back in, diving back in, wrapping my head around what's been going on in my absence here, and gearing up for earnings season. I did miss the jobs report. Don't like to miss the earnings too much. So, although I don't like to miss the jobs report either, Brad. I can sum it up for you. I'll sum it up for you very briefly. Economic misses across the board last week, whether it was JOLTS, whether it was the ADP, private payrolls, and then on the employment front. That was interesting to watch as that came through. But then again, we had some amazing breakdown here and what that may signal for the Fed in their next policy meeting going forward from here. In terms of how it relates to, hey, let's get Tesla off of there. Let's take a look at some of the major averages here on the day. We were taking a look at them and we've got them loaded up on your screen there as well. That's going to populate. But as of right now, we're seeing some declines across the board for the major averages out of the gate. The Dow Jones Industrial Average, you're seeing that lower by about 0.4% right now. And just to give you a little bit of context on the move that we've seen over the past 5 days, so coming into this week, still holding on to net gains up by about 0.25%, a little more than that. We'll round that off too. The Nasdaq Composite, you're seeing that net lower over the past 5 days coming into this week, down by about 2%. Here today, adding on to some of those declines, it's down by about 1%. And the only place that you'd like to be in the red is on Augusta National Golf Course, but here on the red is S&P 500 right now. That's not a good thing. That's down by about 0.6%. Little nod there to John Rahm, who won the Masters over the weekend here. Had to give him a shout out there. Also, let's take a look at some other green and red areas here with the S&P 500 11 sectors. As of right now, it seems that energy is the only mover to the upside. That's up by about 0.9%. Let's give you a little bit of a year-to-date look as we begin a new trading week. As of right now, down year to date by about 2%. That's after, of course, last year's move that we had seen. We'll put this kind of in a 2-year view for you there. Over the past 2 years, still holding on to gains of about 78% there. But here, bringing it back to today's activity, you've got consumer discretionary bringing up the caboose. That's down by about 1.2%. And then technology also taking a hit here out of the gate this morning. That's down by about 1%. Speaking of technology, let's take a look at the Nasdaq Composite, or the Nasdaq 100 rather. Deep declines across the board. Very few places of green to be found. Micron is one of them, though. That's up by about 6%, as we were discussing earlier. Julie?
That's really interesting to see Tesla down by so much after announcing that it's building that new Megapack factory in, we also had the price cuts over the weekend for Tesla. So that's probably more to blame for what's going on.
Coming off of a big auto week here in New York City as well. The auto convention, New York International Auto Show taking place last week. We had some coverage there for Yahoo Finance Live. And a lot of the discussion was around some of those price wars that were really ensuing within the electric vehicle landscape. But again, some big news there on the price front with Tesla. Year to date, still holding on to gains by about 44%, though.
Yes, indeed. All right, let's talk about some other movers here. You were just talking about energy movers a moment ago, probably helping that energy group. Shares of Pioneer Natural Resources gaining. The Wall Street Journal reporting that ExxonMobil is reportedly eyeing a potential acquisition of Pioneer. Discussions between the two companies about a potential deal have reportedly been informal. Again, this all according to the Journal, but this would be an enormous acquisition for ExxonMobil, the largest since Exxon bought Mobil and became ExxonMobil. Pioneer's market cap is around $49 billion. It is a huge fracking company. So this is what ExxonMobil would be buying if indeed it went through with this deal. Exxon's got a lot of cash on hand right now because it's been pumping a lot of oil. It's been making a lot of money. Yeah, and I mean, it gives them perhaps a drilling entity with reserves in the biggest fracking hotspot specifically there. But then, I mean, it's hard to understate how large of a deal this would be. Biggest since Mobil, as you mentioned, and particularly here, it still, even as we were looking at the backdrop with XLE and energy moving higher here today, and the year-to-date kind of pullback, this still comes over that net positive move that we've seen over the past 2 years with 2023. Energy really just moving to the upside, continuing to be the major bright spot over that period of time. And over the past 52 weeks, still holding on to gains by about 7% as of right now. But this would be, no doubt, a mega deal, and it begs the question of whether or not, given some of the profits that these companies have been able to take in over the past year, whether we would see more deals be struck in this environment right now, too, on favorable valuation. The profits that they brought in, and also facing a future where we are seeing a wind down. Right. Even though if that wind down might be more extended than we had anticipated pre-pandemic, nonetheless, looking for a sort of strength in size kind of situation here. Absolutely. Perhaps. Well, let's talk about Tupperware here. That's the best segue that I could give you folks. Consumer products company, global consumer products company Tupperware brand engages with financial advisors to help improve its capital structure and near-term liquidity. Okay, so layman's terms here, they're going to try and avoid delisting. They are also, as you're seeing, shares down by about 40% here on the day. They're trying to make sure that they kind of are
are able to avert some of the kind of credit facility crisis that they do have right now. Increased levels and cost of borrowings under that credit facility most recently have become in question, and this is a company that is listed on the New York Stock Exchange. It seems that they've already received delisting notices, and we will see what action further here the New York Stock Exchange decides to take should this effort from Tupperware prove ineffective as well.
Well, you have to wonder about the sort of secular decline in demand maybe for Tupperware products, right? There's a lot of competition. There are other companies like Rubbermaid that make the same stuff.
Yeah.
And I don't know about you, but I just save my takeout containers and reuse those. So I'm not buying a lot of Tupperware these days. But obviously a strong sort of legacy. It has sort of, it's one of these brands, consumer brands that has sort of sentimental value. In a way, you think of Tupperware. I mean, like you might not be old enough for this, but Tupperware parties back in the day, right? That our moms maybe had. I don't know.
Yeah, absolutely. I mean, well, so that begs the question: did delivery kill Tupperware? Because if we're all just holding on to the containers that get delivered to us, maybe once, twice a week, in some cases, maybe a little more because I get lazy and don't cook as much as I should, but I still am putting the leftovers from the food that I do cook in the containers that I get on the 1, 2, maybe 3 times delivery a week.
Yeah. So maybe that's what's up.
Uber Eats, the inverse relationship with Tupperware.
Oh, we should chart that somehow. Exactly, I like it.
You can also chart it on the Yahoo website right now, yahoofinance.com. Everyone, go check out that charting feature coming up on the other side of here. We've got the chart master, Yahoo Finance's Jared Blickery, going to break down the latest market action to kick off the week. More charts next. It's time now for our chart of the day. Americans saying they need at least $1 million to retire comfortably, but most don't believe that they will actually meet that goal. Millennials predicting that they will need to accumulate $1.3 million, according to a new retirement survey from investment manager Schroders. But less than 30% think that they will hit that target. Older workers are even more pessimistic. They guess that it's going to take about $1.1 million for a comfortable retirement, but only 21% foresee hitting that benchmark here. I am in that millennial cohort. I got a lot of work to do here, but a lot of time I have guessed relative to some of the boomers that are out there.
Well, there are kind of two interesting things about this story. There's, first of all, the fact that people are just like picking this number.
Yes.
I don't know if it's based on any actual
where an advisor is
that
pointing
they have
them towards that
done,
number.
right? Or if they've done sort of a calculator of what they'll need for retirement, or if they're just sort of picking a number out of the air. So that to me is the first sort of interesting thing about it. The second thing is knowing that, or believing that they're not going to make that number, but not necessarily doing anything about it, or maybe even not being able to do anything about it. I mean, most retirement experts will say you should max out the contributions to your 401k if you are fortunate enough to have a 401k.
Right.
But that barring that, you should make any kind of minimum contribution to the 401k if you can. You know, so it's like, can you spend less now in order to have more to spend later? It's a difficult thing to do.
Right, and 401k, the time period that it was established, 1978, that became kind of the benchmark of what you had to save up to retire. And so if you're layering on everything from the cost of living or the inflation in so many different parts of how that retirement figure would be determined later on, then perhaps you work your way for us millennials up to $1.3 million somehow to be comfortable. But again, it's whatever your own comfortability of living, you know, everything that goes into that, what that golden picture of you retiring looks like.
Yeah, there's so many relative parts of this report.
Yeah.
It's hard to know what to do with it on an actionable basis, except put money away. If you start putting money away, if you haven't started already in some form, whether it's 401k or something else.
All right.
Yeah.
Put a plan together. All right, we're gonna help you do that too. Welcome back, everyone. We're also gonna take a look at some of the interactive activity that we've seen here early in today's trading. Let's bring in Yahoo Finance's Jared Blickery. He's got a little bit more early on today's tape. Jared?
Yes, we're starting out the week on a little bit of a downdraft. You can see everything in the red there except for the small caps. But let me just show you what's happened the first 5 trading days into this quarter, because it's looking a lot like 2022 and unlike the first quarter. That's when we had the Nasdaq and tech stocks soaring. So here's the Dow. It's actually up 44 basis points, less than 0.5% over this time period into the new quarter. Take a look at the S&P 500, down about 0.75%. The Nasdaq down over 2, almost 2.25%. And then the Russell 2000, that's off the most, 2.5%. So if we are in an era where we're just kind of mimicking last year's trade, just remember what that entailed. Here's a 10-year T-note yield. Just want to show you what's happening in the bond market. This is a 3-month chart. It was only Friday that we hit new 6-month lows, and then we are up 10 basis points here. That's the 10-year. Then want to show you the 13-week T-bill. That's up 8 basis points. This closely tracks what the Federal Reserve is doing on the short end of the market. And here we have those highs that were before the banking panic last year, and last month, and we're surging towards those highs once again. So all of this painting the picture that we're probably going to get that next rate hike in May, and from there, who knows? But the rate cuts are getting priced in steeper and steeper towards the end of the year and early next year. I'm going to do a deep dive on the tech market and expectations for that field in terms of earnings at the beginning of the 11 a.m. hour. So look out for that. Here's energy. Here's our sector action for today. Energy in the forefront, some excitement over that Exxon Pioneer deal. That's up about 1.5%. Then industrials and materials. Those are the only green three sectors that are in the green there. Tech, not surprisingly, due to the Apple news. We'll get to that in a second. That's down the most, off 1.25%, followed by communication services and consumer discretionary. Those round out the mega cap sectors. So Tesla's a standout there. That's down 4%. But I did want to do a little bit of technical analysis on Apple, and just want to show you from the peak, which was January 1st or 2nd of 2022 last year, we have now come and nearly perfectly touched this upwardly sloping trend line. We came at it rather quickly, so it was arguably overbought here. My point is, to get through this threshold, it's going to take a major catalyst of some sort. Maybe some good news on the CPI front, or maybe just going to have to wait towards earnings season. But Apple, as one of the 2 biggest stocks here, the other one, Tesla, if both of those are having a bad day. Hard to see much good news for the overall market here.
All right, good stuff there. Our own Jared Blickery charting Apple for us this morning as well here. Some of those lower highs. Hey, I got one technical term for you a week, Jared. I promise you that. Coming up, everyone, Tesla is doubling down on its mega pack production, where the EV maker is planning its new mega factory. That's coming up next.
The New York Auto Show is here, and as attendees rush through the gates of the Javits Center to see what's latest and greatest and what's next in the world of EVs, what they won't be seeing is this brand, Tesla. That's right, Tesla. Tesla doesn't really go to auto shows in general or even industry events. They usually do their own thing. And what they've been doing lately is dominating the field of EVs from both a production but also a scale point of view. But now Tesla is leading in a new area, pricing. Only weeks ago, they threw down the gauntlet, cutting prices of the Model 3 and Model Y cars by thousands of dollars. Rivals like Ford and even Chinese rivals had to cut prices in order to compete against Tesla's latest move. And right on cue, Tesla reported Q1 delivery numbers that were record highs for the company as they showed that cutting prices boosted demand considerably. And 2023 is not only a big year for EVs and EV SUVs in general, but also pickups. This year at the show, the Ram Revolution EV pickup will be there, as well as the Chevy Silverado EV, in addition to the Ford F-150 Lightning EV pickup. Now, what's not going to be there again is Tesla and their Cybertruck. Cybertruck, Tesla says, has over 100,000 pre-orders, and it will go into production later this year.
Tesla slashing prices on its whole EV lineup for the third time in the U.S. this year, as it looks to counteract rising interest rates, with the EV maker making the biggest cuts on its slower selling, more expensive S, that large sedan, and of course the X, big SUV there. Now, of course, what has come to light or come to the market recently is the production synergies that they do have between the Model 3 and the Model Y. The mass market Model 3, of course, that's gotten so much of the fanfare and so much of the purchase orders that have come through for Tesla. When you think about the 3 and the Y, that is essentially the lion's share, the majority of the number of productions and produced vehicles and deliveries that the company is making now. So where are those profit margins continuing to come in from? Well, that's what the company has tried to continue to be more vocal about, saying that they're not seeing this hit margins as much as some of the other automakers would if they were to go wholeheartedly into this pricing war as well. And we were able to speak last week about more of some of that pricing strategy that is set to come through, especially at Ford too. Their CFO joined us and essentially talked about their own confidence in being able to maintain prices or at least be competitive within this pricing environment as well.
Right. I mean, it's interesting that this announcement is taking the stock down by so much, because most of the analyst commentary I've seen have said it was expected, maybe not the timing, maybe not the magnitude of the pricing cut, according to those like Tony Sacconaghi over at Bernstein. But nonetheless, I mean, to see it down almost 4% is interesting here. And to your point, this balance, this dance between margins and volume, it does seem obviously that Tesla is prioritizing volume and getting the delivery numbers if they want to meet their forecast, that they got to sell more cars is the bottom line. And this is the way they've seen to do it. At the same time, Tesla's making that announcement of the new Megapack battery factory near Shanghai, which is also interesting because Tesla's sort of continuing its trend of being sort of geopolitical agnostic, if you will, at a time when we are seeing China conduct military exercises following the visit of Kevin McCarthy with the president of Taiwan. And so Tesla then making this announcement. It's just interesting timing that it is happening right now, although I guess you can pick any time over the past couple of months. It would have been a time of tension between the U.S. and China. Well,
still, one of the most cited unknowns or headwinds that many CEOs and Tesla, of course, has to acknowledge what that headwind has looked like. And they have, even in their most recent earnings call, as we were listening in on after the call, in their most recent kind of press conference that had questions from both retail investors as well as institutional investors, what Elon Musk saw as one of the biggest headwinds. And he did cite kind of this force majeure type of event, which is typically seen as kind of like an act of God type of event that would be happening. And the geopolitical tensions cited within that. And so that being one thing, but I think, even within how they're going to be going about moving this forward, they're going to break ground on the plant. That's going to start in the third quarter. Production, that's set to commence in the second quarter of 2024. So those are some of the timelines to continue looking at here.
Yeah, and speaks to Tesla's ambitions beyond vehicles, right? That this is a product that's designed more for the grid than it is for cars.
Yeah, absolutely. We're going to be watching shares of TSLA coming up. On the other side, though, we're going to speak with one analyst on why he says, despite Nike's scale and size advantages, meaningful margin growth remains a concern. That's coming up next.
Well, despite an overall increase in consumers using Nike's direct channels to buy their shoes, gross margins and earnings before interest and taxes fell meaningfully. That's according to new research from BMO Capital that cites the 10Q and suggests that after 3 years of going all in on its direct channels, Nike might need to reconsider that DTC and wholesale strategy. Here to weigh in is the man behind the note, BMO Capital Markets Managing Director and Senior Analyst specializing in retail. That's Simeon Siegel. Simeon, it's good to see you. This has been such an interesting move that we've seen over the past few years from Nike, and it's had all kinds of effects on its relationships with its vendors, like a Foot Locker, for example. Does it need to pivot backwards, or what do you think a new strategy needs to look like here?
Gosh, Julie, you just made me probably the only person in the world that can make Nike sound less fun here. Like the amount of words there, technically speaking. No, listen, so you and I have been talking about this for a bit. I think that there is this view that you eliminate wholesale, you eliminate a fee, that must naturally be better. And just it is surprising, but mathematically it just doesn't work. And so what we're seeing the growth. Someone is paying that cost. Now it's Nike as opposed to letting someone else do it for them. And so I think there was this magic word called omnichannel, and we forgot about it, right? We started gravitating towards e-com, and we started gravitating towards direct. And the reality is Nike is where they are. They are one of the largest sellers of products in stories in the world because they embrace all the channels. And so I think you have to be strategic. Don't sell through everyone. Don't just give away your product simply to sell more units. But to say we're just going to move away from wholesale, I mean, that we are seeing mathematically is damaging.
You know, Simeon, I've had a lot of great conversations with the president of consumer and marketplace over at Nike, which is Heidi O'Neill, and particularly the environment that they've been able to kind of take advantage of with direct-to-consumer and growing out that Nike Direct business. It's been one that was largely started by some of their other competitors, and Nike, of course, had the size, the scale to be able to make a huge, not just ripple effect, but a wave within the way that athletic footwear and apparel was then sold to their own customers. But we've seen kind of a pullback in some consumer discretionary dollars. So my question to you is, how much of the growth story right now is really just hinging on that pullback in some of the demand and people looking around perhaps their apartment here in New York City where you only got one closet saying, you know what, I might have too many shoes at this point?
No, God forbid. God forbid. No, listen, I think there's a lot of different aspects. I think we're watching wholesale do really well. I think we can't talk about Nike's strength right now without acknowledging some weakness at a very large competitor because they are no longer selling Yeezys, right? I think there is an element here where there is a timing factor, but I think more than anything, Nike has never struggled to sell more units. I think the question is where, how, and how much do you get for it? Listen, a fascinating stat that we saw this quarter, Nike revenues were up 14%. That is a huge number off of a very huge base. The problem, Nike profit, the actual operating profit dollars were down almost 14% too. And so, like Julie, it goes back to the conversation you and I have been having throughout the pandemic of the sell less, charge more. If you sell more and you make less money for it, is it a good trade? And so I think it's fascinating. I think the demand is very much there. I think the question becomes, how do we turn that into healthy profits? And so to your earlier point, the size and scale, no one markets better than Nike. No one can ultimately compete with their check size, whether it's R&D, whether it's marketing. And so the question becomes, do they compete against themselves? And so that's where I think what we are seeing is the sequentially improving inventory, the sequentially improving gross margin. It's less bad than it was. But what we need to internalize is also this growing expense bucket. And so when your operating overhead is growing faster, that is what happens when you go direct. When you go direct, what you're basically saying is, I want to recognize the full revenue. I don't want to share the product margin. But by the same token, I'm willing to absorb all of the operating expenses. Letting other people absorb some of that operating expenses is how Nike got to the size and scale and profits of where they are in the first place.
And then there's another sort of big picture question that I have been asking periodically, which is, are we anywhere near peak trend, right? With this sort of the shoe craze and the Nike hotness in particular. Are still upward sloping here?
Listen, I think we'll see at the box office. I haven't seen the movie yet, but we're talking about the origin story of Nike hitting theaters now. I mean, I don't know if that's a jump the shark or if that's a fuel the momentum story, but I think what they have been historically fantastic at, Nike hasn't always had a smooth run upwards. What they've been historically fantastic at is watching competitors emerge, taking their time to recreate the product that they need to create, find what the trend is by going back into their archive, but also embracing new technology, using that spend, using the size and scale, and then effectively implementing the next phase. I mean, remember, there was, I don't remember, 5+ years ago when Adidas came in and created the Ultra Boost, and all of a sudden there was competition. Many years earlier, Reebok did the same thing. So I think Nike's beauty is there hasn't been a peak trend because they're effectively paying a lot of money to help craft it, even if they're not the leaders all the time. So I think that's what we will see. But again, I think at the end of the day, this is a very, very large business. I mean, multiples higher on a revenue basis than other competitors. And so figuring out how high is high from that business perspective, I think will be important and will be interesting. And let's not ignore the fact that this is not, there's the wholesale conversation is fascinating on both sides of the spectrum. It's fascinating on the Nike side of the conversation because they have so much wholesale and now they're effectively moving away. On the startup side, people took that same message, and that was the digitally native story. That was the perceived D2C story of let's just start by not having wholesale. And that has now been proved to be the wrong model as well. And so I think from that perspective, I'm less concerned about Nike demand. I think the question will be, what does that parlay into profits?
Certainly. Two-part question here, and then we got to let you go, Simeon. First, have you seen the movie? Have you seen The Air? Do we need to go see it?
Not yet. It's been we've been Passover breaked right now, but dying to.
Okay.
I'll get there.
Okay, done deal.
What about
All
you
right.
guys?
We'll put that on the Google Calendar.
Not yet.
Secondly, here, when you think about the other sneaker companies that have said running is resilient, especially in a pre-recessionary environment and consumers trying to get their hands around costs for everything from what they're wearing to, up top to on their feet. For Nike, does that same resiliency hold true when it is a company that you've said is competing with itself and some part of the businesses might be hamstringing other parts because of the differing release schedules that they have?
It's an excellent question. I think if you think about discretionary brands, they're generally smaller than staple brands. So need-based purchases can be larger than want-based purchases. And I think the reason is because of replenishment. The running is resilient also recalls the fact that you wear out your shoes. And so I think a big part of this is simply the question of like the holy grail is creating a discretionary product that's also a replenishment item. Because at the end of the day, if you're walking on these or you're playing in these or whatever it is that you're wearing through these shoes, you're talking about your closet full of the New York studios that have unworn shoes. But when we think generally about the volume that Nike sells, these are products people are wearing through and have to come back. And so I think that that's this interesting dynamic as well, where as long as you are discretionary with replenishment and you have the marketing dollars behind it, you create a story that people feel compelled to keep coming back to. And I think that's been effectively the magic of Nike.
Well, we'll see once we all see the movie. If we think it's peak,
let's see it.
Or we'll make our assessment. We'll have you back and talk about it. BMO Capital Managing Director Simeon Siegel. Thanks, Simeon. Good to see you. Coming up, a new survey from payroll software company Gusto shows that despite economic uncertainty, new business creations are up 30% from pre-pandemic levels. We'll speak with an economist behind the survey. That's next. Let's take a look at the latest market action as investors look ahead to key consumer inflation data out this week and the start to earnings season. I'm Julie Hyman. That's Brad Smith. This is Yahoo Finance Live. And we're seeing a big divergence today that's quite interesting. So the Dow is little changed, as you can see here, not even down a whole 0.1%. The S&P 500 is down much more, 2/3 of 1%. And then you got the Nasdaq Composite, which is off 1.25%. So a big divergence between those two major averages. If you look at the trending tickers sourcing straight from the Yahoo Finance platform and what users like you are looking at, you can kind of see why. Here's Tesla. We got it down 4% today after the company cut prices reportedly over the weekend. Those shares are down by 4% here. Apple shares down 2.5% after that report out from IDC that its PC shipments fell by more than 40% in the first quarter. PC shipments overall down 29%, as we discussed earlier in the show. Apple, though, taking the biggest percentage hit. So that's why you got these trading tickers. And the Yahoo and the Nasdaq 100 futures, the QQQs, are actually on the trending ticker list as well. So a lot of attention on the Nasdaq today and some of the selling that we are seeing there. So it's quite interesting to see that unfold even as the Dow kind of goes sideways. Here's the Nasdaq 100 and your look and all of the red we see on the screen. And it's not just Tesla and Apple, Microsoft, Alphabet, Amazon, Meta are all trading lower today as well. Brad looked at the sectors at the open to get another check here. We've got the XLE that is still holding the leadership position to the upside here today. Industrials as well, and that helps explain why the Dow is doing better than the Nasdaq 100 today, right? And then these two groups help explain why the Nasdaq isn't doing well. That is, we've got tech here and we've got communication services that are bringing up the rear here and lagging and holding back any gains that otherwise might be happening in the Nasdaq 100. Since this is going to be a big week for inflation data, as well as for implications for the Fed, we'll see what ends up happening with those two now interest rate sensitive groups, Brad.
All right, a little bit more green on the screen there on the sector front since I was over there. Yeah, that's the Julie Hyman advantage right there for you folks. Thanks so much, Julie. Also, entrepreneurship, it continues to rise in the U.S. even years after the COVID-19 pandemic, as 2022 saw 5 million new businesses form. Here with the breakdown on what's driving the shift to entrepreneurship and more. We've got Gusto economist Luke Pardue. Luke, great to have you here with us. All right, so just walk us through this rise in entrepreneurship. What's really driven it, and what's been the net positive for so many of the entrepreneurs that are trying to just make this dream, perhaps this venture, a new reality for themselves?
Thank you so much for having me. And you're exactly right. In 2022, we saw 5 million new businesses being formed, which is a spike from the, say, 3.5 million new businesses we saw formed in 2019 before the pandemic, when entrepreneurship had actually been declining for the last few decades. And at Gusto, we serve over 300,000 small and medium-sized businesses, and we surveyed those owners who started a business in the past year. And what we've been seeing is that since the pandemic, there have been a number of causes that as the economic landscape shifts, the root causes of entrepreneurship have been shifting. And so in 2022, what we saw was flexibility come to the forefront as a need for entrepreneurship and starting their own businesses, as a lot of demands on these employees' times cause them to strike it out on their own and start a new business. But also inflation has come to the forefront. 41% of these new business owners started a business because of rising costs. And what we saw was that was up from 24% just a quarter in 2021. And so, as we see these rising costs take a bite out of household budgets, a lot of business owners are shifting to entrepreneurship in order to provide that financial stability that they need.
At the same time, what's interesting, Luke, is that while economic conditions may have driven people to start businesses, wouldn't it also hold them back from being able to start business? In other words, where do they get the cash from to start these companies?
Yeah, that's a great question. And I think it's something that a lot of economists are looking at, that 2020 was actually the first time since a lot of this data has been tracked that entrepreneurship increased during a recession. We've never seen that before. And so it's a puzzle that we're looking at still today. But one of the reasons that we're seeing entrepreneurship increase is that a lot of the technological barriers to starting a business have fallen, as we've seen the rise of a lot of tech tools like apps. People can, start that bakery in their kitchen. They can start that accounting firm at their dining room table. And so, you don't need that brick and mortar office. You don't need a lot of the fixed costs that entrepreneurship required before the pandemic. And so a lot of these entrepreneurs are taking advantage of the disruptions, not only from consumer demand, but also just the lower barriers to starting a business.
When you think about the entrepreneurs that are also going to rely on some type of funding, whether that be friends and family or whether that be going to the bank to try and get some type of loan to begin that business, has there been a hit on any of the entrepreneurial sentiment given the the bank turmoil that we saw ensue mid-March?
Yeah, that's a great question. And we actually asked these business owners just from February to March as this was happening, how they were thinking about the economic outlook, which they are squarely focused on. And we see a lot of them starting to increase their cash reserves. They're not necessarily hiring fewer employees. They're not trimming their investments yet, but a lot of the savings that maybe might have come from their own account or been tapped from friends and families are going into that sort of, maybe quote unquote emergency fund, that they're starting to increase their saving buffers a little bit to maintain that flexibility, just to see how things pan out over the next quarter, say.
Do you expect to see a downturn in small business creation in this environment, considering that we're looking at numbers like interest rates going higher, but not only that, banks maybe not being as willing to lend?
Sure. Yeah, we're definitely keeping an eye on how these lending standards are going to affect new business creation. But I'm actually very bullish on this trend of entrepreneurship that, like I said, 2020 was the first time during a recession that we saw an increase in entrepreneurship. And I think that dynamic between, when people think it's a good time to start a business and when it might not be a good time to start a business has sort of flipped. And, entrepreneurship is not necessarily now just for boom times or for even normal economic times, but it's for all people at all times. And, even if we think about uncertainty in the job market right now, the 9-to-5 employment that a lot of people relied on isn't as stable as it used to be. And so a lot of people are going to entrepreneurship because, there is some risk there, but at least you have the opportunity to determine your financial future.
Did you see any considerable shift or kind of net rise in the number of entrepreneurs that are specifically focused on what has been one of the top trends, or at least terms that everybody's trying to wrap their heads around over the past 6 months, in artificial intelligence and the new form that artificial intelligence has taken on in generative AI?
Yeah, that's a really an interesting point, because actually we added one question this year, which is, have these technological disruptions increased or been a factor in starting this business? And we saw, particularly among younger folks, that sort of under 25 segment, that was the largest sector that took advantage of these technological disruptions. So, even as this overall landscape is shifting in entrepreneurship, younger folks are starting new businesses at higher rates right now, and they're the ones taking advantage of these sort of AI disruptions and everything that's going on within technology right now. Younger folks are getting that foot in the door in entrepreneurship because of technology right now.
Interesting. Luke Pardue, thank you so much. Gusto economist, talking us through that survey and what's coming next for small businesses. Thanks.
Thank you.
Let's look at a trending ticker right now. It's Capital One Financial. It's taking a hit here, but that hit's a lot smaller than it was in the pre-market. Walmart has asked a federal court to allow the termination of its credit card partnership with the bank. The retail giant's lawyer saying in a lawsuit that unfortunately Capital One was consistently unable to meet the customer service standards required by the contract. That contract was made in 2018. It resulted in Capital One as the sole issuer of the retailer's private label and co-branded credit cards. As I mentioned, those shares were down earlier in pre-market. Now they're only down about a fifth of 1%. And analysts who cover Capital One saying this should not cause a big hit to earnings. Coming up, brewing up a mixed fourth quarter earnings report. We'll speak with Constellation Brands CEO Bill Newlands about the outlook for booze. That's next.
Leadership in times of economic uncertainty, one of the critical elements is around communication, transparency, and I think it's frequent communication, and probably most important is authenticity, being authentic and having people trust that what you're telling them, right, is accurate and enables you to lead the company or the teams through this period of uncertainty. I have not changed leadership style during this time of uncertainty. And if you add the pandemic, which was a very uncertain time for so many people, one of the things that we have seen is during this time of uncertainty, and particularly through the pandemic, people were looking for more leadership from the company and from the leaders of the company, and including taking positions and communication on things that may not be directly business related. So I've felt even more accountability and responsibility in my role as a leader as we've been going through such an uncertain period of time for so many employees. Clearly, trust and confidence are really important to lead people and lead teams. And so I'm looking for those in people who can build and create trusting relationships. Collaboration is also very critical. I'd characterize it as a coaching mentality as opposed to a management mentality. Coaching means I'm investing in people to help them perform well and to be successful, to achieve their objectives, as opposed to I'm managing a group of people. So all those I think are really important. First, I'd say do what you're passionate about. Make sure that you believe in the purpose with what you're doing, because if you do that, you can do something with much more energy, enthusiasm, authenticity, and you could be that leader that people will look up to. And then the last thing I'd say in terms of recommendation is lead by example. Don't ask other people to do what you're not willing to do, and people are paying attention to what you're doing more than what you're saying.
Beer, wine, and spirits maker Constellation Brands reported mixed earnings for the fourth quarter, topping expectations on the bottom line, but missing on revenue. Sales were down 5% year over year. Joining us now to discuss, CEO of Constellation Brands, Bill Newlands. Bill, it's always a pleasure to get some time with you. Thanks for joining us this morning. I know that the different types of alcohol got a lot of attention, and beer in particular got a lot of attention. With you guys discussing sort of the outlook this year, sort of some of the California weather effects that have caused some issues, but it sounds like you're fairly optimistic that you think beer demand in particular is going to rebound throughout the year. Can you talk us through that a little bit?
Sure, we are, Julie. And admittedly, California has been a bit challenging. You know, they've had rain, snow, flooding, et cetera. But on the other hand, we see markets like Texas and Florida and New York that are up double digits in the first month of our new fiscal year. So we're very optimistic that that it's going to be a very solid year. And we all recognize one of these days it will stop raining in California and they'll get back to normal weather.
Bill, Brian here, good to see you as always. In terms of inflation, was the quarter you just reported the highest inflation that investors are likely to see over the next couple quarters?
Certainly it's moderated some, Brian, but it's certainly not back to where it was before the inflationary trend started. That's certainly going to be the one big watch out is what does inflation do over time and what does it do to particular commodities? You know, we obviously hedge where we can and again, we've factored all of this into what our expectations are in our guidance, but certainly inflation is one of those characteristics that's been a bit stubborn.
And so when you think about some of the different areas that the business operates right now, Bill, of course, across beer, across even some of the seltzer products or even canned cocktails, what is going to be that next leg of growth from your perspective for the company that you're ready to go all in on?
We got a couple of things we're very excited about this year. We're introducing the gold standard of light beer called Modelo Oro this year. It was just introduced starting last month, and we're very excited about where that can go. So that's one. We're doing Corona non-alcoholic. You know, the whole betterment trend is one that we're certainly seeing across our consumers, and we see it across many other consumer product sectors as well. So we see those as being real opportunities. And then you add in the tremendous growth that we've had in our Chelada business, where a number of our new product areas and our new formats there have been very successful. We think there's many, many things that are new offerings for the consumer that are going to be very positive in our overall mix this year.
Bill, I was thinking back to our prior chats, and we never really seem to talk a lot about the wine business. Now, you called out weakness in some more mainstream brands. What do you think that is driving? What's driving that right now?
A lot of challenge in the mainstream segment, and we've obviously brought down our exposure to the mainstream segment. It used to be 60% of our business. With some of the sales that we've made, it's down to 40%. And the higher end of the business is growing tremendously. But certainly the mainstream segment has been challenged, and we do still have exposure to that. But outside of that, when you think about The Prisoner and Naomi and Kim Crawford, our craft spirits business, things like High West, are all doing extremely well. But certainly the mainstream segment has been challenged and probably will continue to be for a bit of time.
Bill, what do you think the drink of the summer is going to be? I know it's a little bit early and, it's kind of a fun question, but at the same time, you guys obviously have to plan around it, inventory around it with the sort of rise and then waning to some extent of hard seltzer. I imagine that's a pretty important question for you guys for this summer.
It is, but one of the things, Julia, that you often see in the summer is that refreshment comes to the fore. And when you think about beer and refreshment are synonymous, and there's no more refreshing beer than Corona. And therefore, we think that's going to continue to be a very strong piece of what we see this summer. You know, consumers are always looking for how they have experiences with refreshing beverages. And we think we're well positioned there, whether someone wants Corona Extra or Modelo Especial or Premier, which again goes after a bit of that low-cal, low-carb betterment trend. So we think we're pretty well positioned for summer, and we're looking forward to it. It's coming up soon.
Yeah, Bill, since we last spoke, we saw Pernod, really a player in the spirits business, make a big play for Screwball peanut butter whiskey. That brand has been hot. I've heard some reports it has slowed down, but nonetheless, are you in the market for a brand like that? Do you want to go out there and start using these opportunities to buy brands like that?
Well, if those opportunities present themselves, Brian, we always look at them. One of the things we're excited about is some of the growth in High West, as an example. You know, many times you see certain individual brands that I would say are a shade more faddish and bring unique flavor characteristics to the table. But people often return to those mainstream bourbon, rye blends of those, much like we have with High West. And certainly we expect that a lot of our attention is going to be to continue to maximize that. We're also seeing ready-to-drink cocktails. You know, we've done ready-to-drink under our Mi Campo tequila business, and as well as High West. And both of those create a bit of convenience, which is another thing that consumers are looking for as well.
Yeah, looking to get saucy too, Bill. Let's be real. At the end of the day, when you think about the consumer taste profile right now and any moderation that would adjust the strategy over at Constellation Brands, you know, what are you seeing among consumers right now, given that you have more of a pulse on them through that direct-to-consumer omni-channel approach that you've been able to institute as well?
You bet. The consumer is continuing to buy more direct than they had prior to the pandemic. You know, our category, unfortunately, had always been a bit behind in that area. And I think the one benefit of the pandemic was it opened people's eyes that you can, in fact, order many of your favorite alcohol beverages direct, or you buy it through three-tier e-commerce, whether it be click and collect or things of that nature. You know, we were very fortunate that we had invested in those sectors ahead of the pandemic, and it really put us in position to be well ahead of what the competition was doing when the consumer began to adjust. But what you're seeing is the consumer doing what they do in many other consumer sectors from which they buy. And I think that speaks very well to us, given the upfront investment we made against those areas.
All right, Bill, we got to let you go. Is there a go-to drink that you're teeing up for the summer?
You know, I'm still a huge fan of Negra Modelo, always top of my list. But I got to say, Modelo Oro is pretty damn good. So I'd encourage you to try some.
All right. We're going to put that on the can and T-shirts. We know you will as well. Constellation Brands CEO Bill Newlands and Yahoo Finance's own executive editor Brian Sozzi. Thanks so much.
Thanks very much.
Thanks. Coming up, assessing your options. The derivatives market has long been a smart way to play stocks, but today it's bigger than ever. And there's a lot of risk that if you don't strike at the right time there. We take a technical look next.
big bank earnings, key inflation data, and fresh news from the Federal Reserve. We've got a huge week ahead for the markets. Here's what you need to know. The country's largest banks will report earnings next week. JP Morgan, Wells Fargo, and Citigroup all set to post their first quarter results, set against the backdrop of a possible banking crisis. Wall Street will be watching closely for performance on deposits and bank liquidity, while top executives give insight into the health of the U.S. banking system. Plus, we'll receive new inflation data and retail sales figures for the month of March. Will we see inflation continue to trend downward? All of this, of course, is being carefully considered by the Federal Reserve. Americans will pick the brains of Fed policymakers throughout the next week as we hear comments from several central bank officials and get a readout of the minutes from the March policy meeting. What does all this mean for interest rates and the stock market? We've got you covered right here at Yahoo Finance.
And now it's time to jump into the options pit with the help of some smart charts. If you're thinking of playing the options market but are daunted by buys, calls, puts, and spreads, then it might be worth taking a look at what the technicals are telling you. The question for many investors, do you want to play the long game, or would you prefer the ability to use options to trade on one-day moves in the market? Joining us now to break it all down, Sean McLaughlin, who is the All-Star Charts Chief Options Strategist. This segment is brought to you by Tasty Trade. Great to have you here with us today. First and foremost, I mean, just compare and contrast playing a long move versus a short-term move in the options market.
Well, thanks for having me on, by the way. But the nice thing about options, I find, and this is really resonating with retail traders in the last year or so, is that with options, you can define your risks better than any other instrument. If you're just simply buying calls when you're bullish or you're buying puts when you're bearish, worst case scenario is you know what your risk is. If the position goes way against you, you have a built-in stop loss. You don't need to do anything special. You don't have to worry about overnight risk of a stop loss order getting filled at a terrible price. You know going in what your risk is, and I think that is what brings a lot of people into the options market, especially retail traders over the last couple of years, as we've seen volumes explode.
Yeah, and volumes, hey Sean, it's Julie here. Volumes in particular have exploded in some of the newer products, and the new hotness, I guess, is what's called 0DTE, 0 days to expiration, which is sort of like the day of option trade. Can you explain to us a little bit about what exactly that is, how it's different, and why it has had such a big appeal as it's been introduced?
Sure. Well, there's a misnomer with 0 DTE options. I get a lot of questions from people saying, wait, they just listed these options today and they just started trading today. No, that's not necessarily the case. What we're seeing now is we have options expiring in the index option space. We have options expiring every single day. So if you look at the options chain in the S&P the S&P options, whether it's SPX, which is the big product, or SPY, which is the smaller product, you'll see an expiration happening every day over the next 14 calendar days, or next 2 trading weeks. So an option gets listed 2 weeks from today. So what's today? Today's Monday the 10th. So Monday the 24th just got listed today. And now that's going to trade every day from now until expiration. And so you have this rolling thing where every day you have options expiring. And this is great for people who maybe they just want to trade options that expire today. They're looking for a very inexpensive way to make a short-term bet. Or maybe they have a specific event coming up. Maybe there's a government report coming out on Thursday that somebody wants to hedge their portfolio against. They could very specifically target Thursday expiring options to do that. So the daily expiring options bring in a whole new realm of strategies and time frames, and it's really resonating.
Are there any downsides to the enthusiasm for that kind of product?
Certainly. One thing that traders with maybe a little less experience aren't familiar with is that when you're buying, let's say, an option that expires today, right? You're bullish and you want to take a short-term bet. If you get it right, it's great. The position goes your way quickly. You can make money quickly. But of course, when you can make money quickly, you could also lose money quickly. If you're on the wrong side of a trend, or if the market just goes sideways, those options are decaying in value faster than any other option on the board. So you really have to get not only the direction right on these trades, but you have to get the timing right. And that could be a whole new level of a game for people.
And that timing, as you were mentioning, largely event specific, perhaps in some of the strategies out there. And so with that event specificity, we think about earnings season that's upcoming too. How much more volume do you see really initiate with this type of options trade as we get into earnings season?
Well, earnings season definitely drives volumes across the board, not just in options,
Right.
but in stocks and in futures and currencies. I mean, it really affects everything. I expect that we will see options volume pick up dramatically, especially with banks kicking off earnings season very soon. We will see the options volumes kick off. And great news for people who trade, particularly the index options, where the volumes are high. The liquidity is very tight. One problem that people often have with options, especially if they want to trade them short term, is sometimes you're trading with bid-ask spreads that are pretty high. So for example, if you're looking at buying a call that costs $1 on the bid, it might be bid $1, offered $1.25. That's a 25% difference between the bid and ask on a typical call. When you're looking at, say, S&P options, those spreads are typically 1-2 cents wide. So in addition to lowering commission costs across the board over recent years, when you're trading with these options products that have tremendous volume, the bid-ask spreads are so narrow that also lowers the cost of participation, which is a boon for retail traders for sure.
Sean, going into this earnings season or going into this week's inflation data, what have you, given that we talked about you being a technician here, what are the charts telling you? What's particularly attractive to you right now this week going into some of these big events?
Sure, good question. One thing that we follow at All Star Charts is relative performance. How are certain sectors performing against other sectors? Relative strength is a big driver for us, is really what helps us sort through the noise and get into the strongest stocks. Right now, the healthcare sector is something we're paying a lot of attention to. Pfizer, Merck, names like that, names you know. There's been a lot of strength happening in that space relative to its peers. Also in the metals space, silver and gold, those are areas, and semiconductors also, by the way. Those three areas, healthcare, semiconductors, and metals, really have our attention. We've been putting on a lot of trades in that area because the charts are telling us so.
Gotta listen to the charts. Sean, thank you so much. Interesting stuff. Sean McLaughlin, All-Star Charts Chief Options Strategist. Our Options Pit interview was sponsored by Tasty Trade. Thanks, Sean.
Thank you.
And we'll be right back.
China escalated its military activity around Taiwan yesterday, carrying out naval blockade drills, according to the state broadcaster CCTV. This marks the first simulated strikes by aircraft carrier-based warplanes on Taiwan, according to media reports. An actual blockade would prevent supplies from entering Taiwan, further isolating the island nation. Joining now to weigh in on the impact of China's military drills is Yahoo Finance senior columnist Rick Newman. Rick, I thought that the markets would be paying much closer attention to this. What are you taking away from the military drills that China is enacting right now around Taiwan?
It's a familiar script, Brad, and I think everybody knew that China was going to react in some way because Taiwan's prime minister visited the United States last week and met with House Speaker Kevin McCarthy and some other congressional lawmakers. So every time there is some kind of connection between Washington at an official level and anybody representing the Taiwanese government, China reacts because China does not consider Taiwan to be a real country. The U.S. position on this, just to remind everybody, is nuanced. The United States does see Taiwan as an elected democracy, but does not come right out and say we view Taiwan as its own country. So China wants Taiwan back, and China's President Xi Jinping has said we are going to reunify with Taiwan at some point in the future. So that implies a military confrontation, but there's no reason to think a military confrontation over Taiwan is coming anytime soon. That would be quite a pill for China to swallow. There would be major economic consequences to China. And just to remind everybody why the war in Ukraine matters so much is China's watching to see what happens over there. Russia tried to grab Ukraine. That's kind of a parallel to what China might try to do with Taiwan. And of course, it's not going so well for Russia. So that may further dissuade China from doing anything anytime soon. But we always have to pay attention.
Yes, we do. And that is a very good reminder about the parallels. I'm looking domestically now and to the White House. President Biden, Rick, he's expected to propose some of the toughest ever U.S. restraints on car pollution later this week. So what's that going to mean for people who have gas-powered, most people who still have gas-powered vehicles?
Well, probably nothing if you have a gas-powered car now, but the idea is to dramatically change buying patterns during the next 10 years. So we don't know exactly what these new rules are going to be. They're going to involve the standards that automakers have to meet for miles per gallon, MPG, or fuel efficiency. But the New York Times reported over the weekend that the goal is to increase electric vehicles as a portion of new car sales from the relatively low levels they're at now, less than 6%, to something around 2/3 of all new car sales by the year 2032. That's less than 10 years away. That would be a phenomenal change in car buying patterns. Of course, that would do a lot of good for eliminating tailpipe emissions, which are a big contributor to carbon pollution and to global warming. But if it happens that fast, it is going to be chaotic at some point. I mean, right now, we don't even have enough electric vehicle chargers right now. There's a lot of spending in last year's big green energy bill to build new chargers and other types of infrastructure and everything we need for EVs. But that would just be it probably would literally be an unprecedented government effort to change the technology of the automobile industry in a super short period of time. So this is going to be quite interesting to watch. If it happens, it'll be amazing, but I think there are going to be a lot of potholes.
All right, we know that you'll be keeping close tabs on it. Yahoo Finance's own senior columnist, Rick Newman. Rick, thanks so much.
Bye, guys.
See ya. Coming up, despite strong direct-to-consumer sales, Levi's raising some concerns with inventory levels. We'll speak with the retailer's CFO next.
700 plus cars on display here. One clear theme: the EV surge is here. It's a great time to be shopping for an electric vehicle. Automakers are expected to spend over $1 trillion in the next decade to develop and deliver the next big thing in EVs. Tesla spends the most on R&D per car sold It also sells the most EVs, taking 4 of the top 5 spots in 2022. But other companies are catching up.
We actually talk to new vehicle shoppers every single month, and we ask them, are you interested in purchasing an electric vehicle? 27% say yes, very, very likely. And the number one brand has consistently been Tesla, but the last few months we've seen Chevy overtake them in brand consideration, and Ford is right there behind them.
More choice, competitive prices, and generous government subsidies are all powering the EV market right now. But one big issue standing in the way of electric vehicle adoption: charging ports.
Now, if you've got a charging station at home, you've got a level 2 station, great, that helps a lot. We're still a little ways away from the great American road trip in an electric vehicle. You know, it's an ongoing process. Things will get better. Folks get these things at home, and then we get more and more infrastructure. The bipartisan infrastructure bill will go a long way to doing that.
California leads the way with 44,000 charging ports, more than 4 times the number 2 on the list, New York. Naturally, some of the country's least populous states, like the Dakotas, have the least amount of EV chargers. And now, even oil and gas companies are building charging stations. BP just announced a $1 billion investment in the U.S. over the next several years. Charging stations are one piece of the puzzle. Another key element for mass adoption of EVs is buy-in from car dealerships. I caught up with Mark Scheinberg, the president of the largest regional automobile dealer networks in the country and one of the organizers of the New York Auto Show. How hesitant are your dealers to making this full transition away from gas-powered?
Well, any business person, when you say, listen, you've got to invest $1 million into this, they're going to go, yeah, show me the return on investment. But dealers are like a lot of entrepreneurs. They see a business climate. They understand that this is what is coming down the pipe. They need to come, to work with it. It is a big investment on their part on it, but they do believe that, this is where the business is going to be in the future.
Shares of Levi Strauss are recovering today after falling 16% Thursday. As investors digested the company's first quarter earnings report, the retailer saw its direct-to-consumer sales jump 12% year over year, making up 42% of its total revenue, but its 33% rise in inventory levels left room for some concern. Levi Strauss & Co. CFO and Chief Growth Officer Harmeet Singh joins us now. It's great to see you alongside Yahoo Finance's executive editor, Brian Sazi. Harmeet, just to kick things off here, some of the catalysts that you see during the quarter right now, what are they, and how do you kind of ride some of those trends that you are seeing among consumers right now who are still purchasing?
First, good morning, Brad and Brian. And Brian, congratulations.
Thanks so much. Same guy, just losing more hair, Harmeet. You know how it goes.
Yeah, no, it's great. To your question, Brad, we had a solid first quarter. We beat top line, grew top line 6% reported and 9% constant currency. And as you said, our direct-to-consumer business was up 12% reported, 16% constant currency. 5 consecutive quarters of positive comp sales growth in our direct-to-consumer business. And as we have said in our Investor Day, our direct-to-consumer business is what is going to lead the company going forward. A lot to feel good about. I think to your question about the inventory actually, the inventory growth came down sequentially quarter over quarter. Q4, it was up 58%. Q1, it was up 33%, but sequentially down, about 25 points. And the company has taken deliberate actions that probably hurt us in the short term in terms of gross margins, but actions to clear inventory and set us up really well for the future. What we have said is the inventory continues to sequentially, the inventory growth continues to sequentially drop quarter over quarter. And we think we'll end the year in line with sales growth, if not earlier than the end of the year. So, and the composition of inventory, because we have a lot of core, 2/3 of our product is core. Think the 501s, the 150th anniversary that we're celebrating, et cetera. We can carry that through seasons. So, we're confident we can get inventory in line with sales growth, which is something that investors really care about. We care about, and we're working hard to do that.
Harmeet, Brian here. Just given everything we have been seeing in the economy, a little bit of an economic slowdown here, soft patch ahead of the spring, what is the appetite among major retailers to put through replacement orders?
Our wholesale customers, are tightening their open to buy budget. However, they have a lot of time and a lot of space for brands that work, and our brand is working, especially brands that provide innovation and newness. And with our 150th anniversary of the 501, you've got new products in. We're also, rolling out non-denim product. So I think newness, as well as, working with brands that consumers trust. And as we are seeing our consumer base, clearly the value consumers who are in the U.S. who are earning less than $50,000, they're pressured. But that's a small piece of our business. Our target base is 50 to 150,000. Folks who earn that much in the U.S. And that group is resonating well with our products. We went into the year thinking it's going to be a tale of two halves. The first half being weaker, largely because of the year we're lapping a period that was had very little promotion, and our cost of goods was much lower. And the second half a lot stronger. It's kind of panning out that way. Plus a tale of two worlds. The Western world a little bit under pressure, the Eastern world, which is Asia, as well as our Latin American business being a lot stronger. Actually, as we end the quarter, our European consumer is generally a lot stronger than everybody anticipated, and showing in our European business. And in the US, I talked about the bifurcation between the value end consumer and the consumer that's largely our target markets. So as long as you bring newness and your products are resonating, I think our retailers are, more open to place orders. But people are generally being cautious, and that's reflected in our wholesale business, that we reported as well as indicated or projected for the year.
Harmeet, it's Julie here. One of our younger producers just informing me that baggy dad Levi's 501s are all the rage on TikTok, which I was not aware of. But I'm curious what it is taking to continue to move product. In other words, what does discounting look like right now, and what's it going to look like for the remainder of the year?
Yeah, it's, Q1 was promotional. We indicated that reflected in our gross margins. Q2, we think, continues to be, slightly promotional. Again, that's incorporated into our guidance. And I think then things get a little better for a couple of reasons. One, people will have lower inventory, number one. Number two, our view is also you're lapping a year, where the second half last year was promotion. A lot more promotional than the first half, and I think that makes a difference. But I think to the point you're raising, Julie, as long as brands can bring in newness, like we have the baggy, product. People love comfortable product. Both she likes it and he likes it, and I think that makes a difference. Our 501, for example, and where we're celebrating 150th anniversary, we've got a lot of new and innovation on that, and I think that's driving business. Our 501 business was up, 25% on top of a 50% growth last year. So I think as long as we can incorporate newness, as well as ensure, because the consumer is a lot more price sensitive today than he or she was about a year ago, ensure that you are able to provide value in terms of pricing, I think that does resonate.
Harmeet, you had taken a net restructuring charge of about $11.4 million in the quarter as well. And when we think about the number of companies that have had to announce some cost restructuring in one form or another, that's often impacted headcount. What would you look to in the performance for the business to say that, there's an all clear, to say that there is a signal that any type of cost restructuring that needs to continue to be done is out the window and off the table?
Yeah, I'd say, definitely certainty in the future. But, going back to, what we did or what we're doing is, and we do this on a regular basis, it's about realigning resources to priorities. And as the, with the macro uncertainty, at times you have to take a hard look at the priorities and say, okay, what will make a difference in 23? and how will things pan out going forward. So, for example, we have a new CDO, Chief Digital Officer. We're taking a hard look at realigning our digital priorities so that we grow our e-commerce business, which for the quarter was up 14%. So that's one piece of it. In the same way as we think about our business longer term, and we're becoming more of a direct-to-consumer company. So we're really thinking hard about how do we organize to be a DTC-led company, et cetera. And it's all about allocating or realigning resources to align with priorities more than a major restructure like you heard from other companies.
Harmeet, a lot of investors on our platform only know you as CFO and then Chip Bergh as CEO. But now there's going to be a little bit of a change in leadership with former Kohl's CEO Michelle Gass, who's currently president, taking over that position. To the extent you could, how might her first 90 days look? How might her leadership differ than you, both of you?
Yeah, first, it's great to have Michelle, with us. She's been with us now for 100 days. And the transition is going great. She's got a real job. Chip has got a real job. I have a real job. And, she's spending the time learning the business, interacting with people, understanding, what is working, what are the areas of opportunity. And it's great. Chip, Michelle, and I have gone on a couple of market tours. We've been to Europe. We've been to parts of the U.S. and we're seeing other parts of the world, really understanding again, what's working and, where the opportunities are. I think to a question about, how will she complement? I think she brings retail skills. She brings, which for a company that wants to be DTC-led is important. She brings e-commerce skills. And she brings skills that will be important as you become more of a lifestyle brand, working on products that are waist up, because that's a clear opportunity for us. And I'm seeing it on the ground as a visit stores. People are seeing it on the ground. And so I believe, the combination of all three of us plus the leadership, that she's bringing forward will actually really help us for the longer term.
Harmeet, great to see you. Thanks for joining us today. Harmeet Singh is Levi's CFO and Chief Growth Officer. Appreciate it. And there's Saz as well. Let's take a look at some of the...
Thank you, folks.
Thank you. Let's take a look at some of the insights we have today at Yahoo Finance. Tax day is coming up fast. Get prepared with the Yahoo Finance Ultimate Tax Guide. Our very own Rebecca Chen is going to cover everything you need to know from rules to extensions.
And AI comes to pharmaceuticals. Can new technology and tools help streamline dosing levels and predict side effects, or is it too unreliable to trust? We're going to have that conversation. The details, the analysis, Yahoo Finance's own Anjali Kamlani brings her insight in the next hour.
And airlines are back in focus as earnings season approaches, and it's summertime, of course. We're looking ahead to our travel. It's not summertime yet. I'm just projecting. Yahoo Finance's Shada Smith and Inez Ferrer are going to chat with regional airline operator Mesa Air.
We're going to have summertime type temperatures here in New York.
It's true, this coming week. So maybe that'll be prompting people to make some of their summer booking plans. We'll see. We've also got a programming note for tomorrow. Jennifer Schonberger has an exclusive interview with New York Fed President John Williams. That's at 9 a.m. tomorrow morning. You don't want to miss that. Stay with us in the meantime. We've got all that and more, and we'll tell you about the next hour of trading. We're going to stay right here for the next hour.
Welcome back to Yahoo Finance, everyone. It is 11 a.m. on the East Coast and 8 a.m. on the West Coast. I'm Brad Smith alongside Julie Hyman. It's 90 minutes into the trading day, and here is what we're watching. Warning signs. The Nasdaq trading to the downside as the rate-sensitive index contends with raised expectations for another Fed hike. Will the impending results season derail the rally? We'll break that down. Plus, crunch time. Fresh data suggests consumer credit could be drying up over the next 6 months, so is the financial system buckling under its own weight? We're going to ask a former Fed trader to assess the landscape. And as the old adage goes, there are only two certainties in life: death and taxes. No point worrying about the first one, but the IRS's Super Bowl is just over a week away. You might be worried about that one too. We've got some details that you need to perhaps mitigate some of that worry and those fears. But first, let's take a look at the major indices. The Dow, the S&P 500, and the Nasdaq Composite all in negative territory to kick off this trading week. The Dow lower by about 0.1%, S&P 500 down 0.6% there. The largest of the percentage basis declines and point basis declines coming from the Nasdaq Composite. The tech-heavy average you're seeing down by nearly 1% as technology is one of the largest laggards on a sector basis here on the day, as XLK is down by about 1% right now. Let's also check in on the Treasury market to see what yields are doing here on the day. You're seeing yields higher across the board. 5-year up by about 5% here on the day. And then additionally, the 10-year, you're seeing that sitting at about 3.43%. That would be a move higher of about 4.3%. 30-year, that's up by about 3%.
Those are big moves.
Big moves, yeah.
Looking at that 17 basis point move in the 5-year, I don't know what's going on here today. Maybe anticipation of those of some inflation data this week. Who knows what's going on there, but we'll keep an eye on it. And let's also take a closer look at what's hot and what's not among retail investors. TD Ameritrade out with its Investor Movement Index for March. It tracks the stocks seeing movements from retail investors. And the big winners this month, names like Tesla, Rivian, and Ford. I'm sensing a theme. The losers, tech stocks like Meta, Nvidia, and AMD. Joining us with more is Alex Coffey, TD Ameritrade trading strategist. And also, Alex, what stands out to me is people were sort of net buyers of equities here. Are you seeing a shift here in people's enthusiasm for stocks?
Yeah, first off, thanks for having me. And of course, it's important to talk about exactly which time frame we're looking at. We're looking at the 5-week time that ended at March 31st. And as you mentioned, TD Ameritrade clients were net buyers of equities, but the actual total investor movement index remained unchanged. And so oftentimes that's a function of the type of names that are seeing buying interest. As you mentioned, there was clearly a theme among some of those automobile makers, but also notably financials were the most bought sector amongst TD Ameritrade clients, with IT being the one with the greatest selling interest. As you can see, the IMX did bottom out, at least for this most recent move, at the end of last year, much like we saw with the overall market itself. And it has started to build, at least on the first couple months, on a little bit of a positive upswing here, but was sideways for the month of March. I was excited to see ultimately what this number would turn out to be, given that momentum that had began to build to start the year. Didn't lose ground, but didn't gain ground either.
Yeah, it's really interesting, Alex, especially looking at some of the popular names that were bought, and including Tesla, Rivian, went on to see First Republic Bank as well within that, which was interesting considering some of the banking turmoil that had ensued. So all of these things considered, are you noticing that the retail investor is continuing to be more of a momentum trader, even in this market right now?
Momentum in the sense that as volatility increases, I think the attention on some of these names increases. Clearly, a First Republic is a key example of that. But they were buyers on balance of First Republic Bank when clearly the momentum was moving lower. So sort of a contrarian approach in many ways, particularly when you look at it on the sector breakdown. As I said, you saw buying into financials, which were down 10% or a little bit more than for the 5-week period. Yet selling on balance information technology, which was up closer to 11% on the 5-week period. So I would say that the volatility of names, of which Tesla typically delivers, garners some of those higher volume, more activity, more eyes on a name like that. But it's almost like a contrarian approach is being applied here attempts to buy into names that are perceived to be at a lower price and selling as names recover. Also a little bit of an indication maybe that those fears of economic slowdown haven't entirely dissipated. Risk sentiment remaining the same, but still net buying of equities, looking for value as opposed to maybe outright growth. Because bear in mind, even a name like Tesla has come down tremendously despite its red hot start to the year. So still a little bit of maybe buying of the dip taking place, if you can say that in a name that's doubled to start the year. Another one that I think really stood out to me was we actually break out a subgroup for population, and we look at millennials. Millennials actually did see that IMX go down by about 1%, and I think that is maybe unique to that age demographic of which I fall in. We don't remember 2008, 2009 like some of the older generations. This may have been that first kind of financial uncertainty, financial scare, and maybe was approached a little bit differently than our older counterparts.
And so what are the implications of that then? Are you saying that's maybe why people got out of some of the tech names? Maybe just a little bit of sort of alarm at what was going on?
I think a little bit of a rotation into some of the names that had kind of sold off with the fear. Of course, the S&P 500 as a whole was up 3.5% during the 5-week period. A lot of that uncertainty was sort of front-loaded at the beginning of this IMX period. And so as those fears dissipated, I think there was a lot more kind of returning to some of these names, and of which technology had outperformed during that time frame. Names like Apple, that was also net sold, had actually been sort of a beacon of quality, or almost like a flight to safety in many ways. And so I think there was some rotation out of outperforming names into underperforming names. But from the population breakdown, I think that there is something to that. I think that there is maybe just a little bit more fear that had been building up. We see that in sort of the everyday market headlines as well. And going forward, I think it's important to note that, of course, risk sentiment didn't change. It's just sort of where the buying took place was maybe names that are a little bit lower beta.
Interesting. All right, got it. Alex, thanks for being here. Alex Coffey, TD Ameritrade trading strategist on the IMX monthly data. Appreciate it. Coming up, the abortion debate is not going away. Conflicting rulings over a widely used drug to terminate pregnancies has reignited one of America's most contentious issues. Does the Supreme Court get involved once again? We'll discuss next. The U.S. abortion rights debate is back in the national spotlight. That's after two conflicting federal rulings over the weekend that all but ensure the debate is set to return to the Supreme Court. The first, a Texas ruling that removes FDA approval for a pill used to block pregnancy hormones. The second, a ruling from Washington State that says authorization cannot be taken away. Joining us with more is Yahoo Finance's Anjali Kamlani. So what are the implications here?
Many implications. So let's start off with, first of all, what the access question is, because that's the key, right? For anyone who's looking for that pill right now, you still do have access to it. It really is up to prescribers and doctors in those states where it's required for prescription. Otherwise, pharmacies can still dispense it. So that's the important bottom line. But looking at it broadly, there are a couple implications when you look at the industry access. So, for example, the authority of the FDA itself is what's at stake. And we know that companies have been signing on to letters, as reported by CNBC, to stop this and to sort of bring that to light. Because if a court can overturn a approval that the FDA has, then things like the vaccine fight that we saw during the pandemic, all those things can start going through the route of the court. So that's what's still at stake. Now back to what access questions are. We know that some doctors are looking at misoprostol. So remember, mifepristone and misoprostol are two that are put together, and that's the regimen for the medical abortion. Misoprostol alone is not as effective according to clinical trials, but it can be given in higher doses and would be considered off-label as an option. Meanwhile, we know that, broadly speaking, the Washington court case does only affect those states that signed on. So it's about 18 states. I looked, and last I checked, I don't think New York, New Jersey are on there, but Connecticut and Pennsylvania are. So that's interesting to note as well. Meanwhile, we also know that even with this Texas case and even with the ruling to halt the distribution of this medication, it will take time to enforce. So even if it does go through, we do have a bit of a window. Now, let's look at the court process. So this is what happens next. We know that the U.S. government and the company that makes this have already appealed, as they were given a week to do so, waiting for that appeals process to go through. At the same time, because there were two conflicting cases, it could come under the purview of the Supreme Court, as you mentioned, Julie. So it could either go straight to the Supreme Court to deal with, or we'd have to wait for the appeals process to go through first. So that's sort of where we are, broadly speaking, as a country.
Really good summary and breakdown there for us. While we have you, another healthcare topic, the medical field looking at how it could apply chatbots and artificial intelligence to pharmaceutical care. Experts from around the industry sounding off on its uses and its pitfalls as well. What can you tell us about this?
That's right. And this also comes as a result of, or coincidentally, I might say, at the time of the Elon Musk and Steve Wozniak letter. We know that there's a lot of concern about the impact of ChatGPT, for example, but also just generally AI use. There are already uses in the industry. For example, Moderna using AI to help figure out the formula for its vaccine. There are also other cases like looking at x-rays or looking at results that computers are already in the process of being used for. But the biggest problem facing the industry right now is that it cannot yet help with smaller tasks, even though that's one of the best uses, according to experts like Bill Gates, who had said that it could help healthcare workers most of the time taking care of things like filing claims and dealing with paperwork and the like. But there's also a next generation of tools that's possible, and that could be much more efficient. He said, quote, they'll be able to predict side effects and figure out dosing levels. So that's one area where it could go. But I've also talked to other experts like a GE Healthcare CTO, Taha Kass-Hout, and he told me that while these technologies can really help, the models have never been trained. There is no multimodal, there is no database large enough for all of this healthcare information because, as we know, healthcare information, healthcare data is private. And so that, for right now, while it's protected, kind of prevents the large-scale learning that we need for healthcare to move forward. So it might be a lot slower for this industry.
Really interesting updates there. Anjali Kamlani, thanks so much for tracking all of this for us. Appreciate it. And everyone, continuing with political news, the U.S. Department of Defense shaken over the weekend by a leak of classified documents and intelligence on social media sites like Twitter and Discord. The leak detailing Ukraine's progress in its war with Russia, as well as revelations about U.S. intelligence gathering on its allies. Here with more, we've got Yahoo Finance's Rick Newman. Rick, what do we know about this leak?
Pretty disturbing if it's true. So this seems to have revealed what American policymakers think some of Ukraine's vulnerabilities are. So, for example, they are running very short of air defenses, and the way that Russia might be able to use that type of information is they might be able to say, well, we thought they were a little bit vulnerable in air defense. Maybe let's find out. So maybe start using fighter jets and other types of aircraft more to see if that's an actual vulnerability. There were several revelations about allied nations. One of them was about South Korea. Ukraine is trying to get artillery ammunition from South Korea, which manufactures a lot of that, and Ukraine is short of artillery ammunition. And this report detailed the political concerns and how touchy this is as a political issue inside South Korea. So that is not the type of thing that U.S. allies typically want publicized all over the world. So it tells you that Korea is basically on the fence. Maybe they were going to try to secretly supply some ammunition to Ukraine, and maybe they will not do that now because it's not secret anymore. The big question here is, how does everybody use this information going forward? So a lot of this is probably stuff that Russia should have known and may have known. So is it going to change anything about Russia's approach to the war? Who knows? Is it going to change anything about Ukraine's approach to the war? Is it possible they could try to use the fact that this information is out there to go in a different direction and effectively use it as a feint? As with all things involving intelligence, it's kind of a hall of mirrors. You don't know how much of it is 100% accurate. Some of it seems to be inaccurate. You don't know if any of this information is planted to be disinformation, and you don't know what other information you don't know. So this gives us an intriguing glimpse into the American view of how Ukraine is doing in the war. But everybody has to remember there's a lot we don't know.
All right, we don't know what we don't know. Rick Newman, thanks so much. It's really true at the end of the day. So we'll see how either of these sides use that data. Thanks so much, Rick. Coming up on the other side, assessing the damage. How is your credit? Maybe not so rosy after SVB's collapse, and it isn't exactly being helped by Fed policy. So are consumers and businesses alike in trouble? We're going to ask the Fed guy and break this all down next.
Big bank earnings, key inflation data, and fresh news from the Federal Reserve. We've got a huge week ahead for the markets. Here's what you need to know. The country's largest banks will report earnings next week. JP Morgan, Wells Fargo, and Citigroup all set to post their first quarter results. set against the backdrop of a possible banking crisis. Wall Street will be watching closely for performance on deposits and bank liquidity, while top executives give insight into the health of the U.S. banking system. Plus, we'll receive new inflation data and retail sales figures for the month of March. Will we see inflation continue to trend downward? All of this, of course, is being carefully considered by the Federal Reserve. Americans will pick the brains of Fed policymakers throughout the next week as we hear comments from several central bank officials and get a readout of the minutes from the March policy meeting. What does all this mean for interest rates and the stock market? We've got you covered right here at Yahoo Finance.
Time now for our chart of the day. Today we're looking at the impact of recent bank failures on commercial bank loans and leases. Overall lending declined by $20.4 billion last week. That was the most in nearly 2 years. And it was made worse, of course, by rising interest rates, a slowing economy as well. Data from the Federal Reserve's H.8, which estimates the weekly balances for U.S. commercial banks, found that total loan activity at chartered banks remained more resilient after the recent bank run, with small banks showing a much larger decline than domestic banks, perhaps not surprising here, given the flows that we have seen into larger banks.
Amid the decline in lending and bank deposits at small banks, U.S. credit conditions have fallen to post-pandemic lows, according to the American Bankers Association. Furthermore, U.S. credit conditions are expected to deteriorate in the next 6 months to their worst level since the pandemic, according to a survey of chief economists at 15 of the nation's biggest banks. Taking all that into account, banks could see lower quarterly earnings and a weak 2023 outlook this earnings season. Joining us now to discuss is the Fed guy, blogger, and monetary macro chief investment officer, Joseph Wang. Great to have you here with us today. Joseph, first and foremost, as we start to think about some of the bank earnings that are set to ensue this week, what most notably would you be tracking, especially with regard to the banks that are most consumer-facing versus those that perhaps have more business or investment banking exposure?
Well, thanks for inviting me. First, I'd like to note that it looks like the banking panic is largely over. The two data points that I follow, the Fed balance sheet data and prime money market flow data, are showing encouraging signs. So when a bank is in trouble, they borrow from the Fed as lender of last resort. Weekly Fed data shows that borrowing is declining. And we also show that money is going back into prime money market funds. Prime money market funds lend to banks, and during the panic, people were pulling money away from the prime money market funds. That's all coming back. So that tells me that the banking panic is over. And as you rightly note, we want to focus on the aftermath. How is that going to affect bank credit creation? As the charts you've show, it does seem to have some impact on small bank credit creation. And that's a problem, because if small banks aren't creating credit, then that means American businesses are not getting money, and that affects economic conditions. So what I'll be focusing on in the coming bank earnings season is how banks describe their impact on credit creation. Are they tightening lending standards a lot? Is loan demand being affected, and so forth? I suspect, though, based on the aggregate data and based from what I see in the banking system, that the large banks are going to be fine. They're going to be in good shape. There might be some small banks that are struggling, but we have to remember that America is a very big place. We have 4,000 banks, most of them small. And it seems like what happened over the past month was largely regional. So I'm optimistic. I think that we could have some moves past this unscathed.
It's really interesting, Joseph, because I think we have two questions here. We have the question of soundness of the financial system, and then we have the question of profitability for the banks. And there, while the big banks might be okay, do you expect to see some kind of hit to profitability as a result of all of this for banks across the spectrum, not just for this quarter, but going forward into the rest of the year?
Yeah, I think that's a really good point. So going forward, I think many people are worried that the net interest margins of banks might be compressed because perhaps banks might have to pay a little bit higher interest expense for their deposits. But when I look at the banking sector as a whole, what I'll notice is that deposits have been very slow to reprice. So if the Fed is just and maybe hold rates, I think that leaves the banks with pretty fat net interest rate margins. The fact is that banks don't really purely compete on interest when they compete for depositors. They compete on basis of service, convenience, relationships, and so forth. And that's kind of how they can get away with paying so many people 0% on their deposit, even as the Fed hikes interest rates to 5%. Now, that's for the net interest rate margin, the loan portfolio part. Now, there might be some problems with the other aspects of the bank's business model. So suppose you have a bank, you have capital markets, you have investment banking, you have wealth management. Well, if we have some, I guess, a downturn in the financial markets, I think that will affect profitability in those segments. So it's going to depend a lot on how diversified a bank's business model is.
Okay, and so if this is true and the worst of it is behind us, then why would we hear commentary from the likes of JP Morgan CEO Jamie Dimon in his annual letter saying that we could still see some of the effects of this for years to come?
Well, there's a lot of uncertainty going forward. And I think one of the effects of this for the years to come is higher regulation. And banks don't really like that. So the more regulation you have, the less profitability, right? Because complying with regulation is pretty costly. So I would expect there to be more regulation and that to have an impact on bank profitability. But from what I see, the indicators that I follow, I think the banking panic is over and we are on the mend. The problem is just how much damage that has happened, and we'll find out more in weeks.
Yeah, as you said, you'll be listening to the calls and to the commentary to see what more color we can get on lending. And so I guess the main question is here, the potential economic impact of banks tightening their lending standards. Can you talk us through that? I mean, you talked a little bit about that, about business growth and creation. Can you talk us through that a little bit more about the potential effects?
Sure. So banks create money. That's their thing. It's not so much that they take deposits and lend them out, but they create money out of thin air. So when you have very strong bank loan growth, what you're doing is you're adding money into the economy. And when you have more money, you have more potential purchasing power. People can go and buy houses, invest in their business, and so forth. So looking at credit growth is a really important leading indicator for how the economy will perform. So if you think back last year, there's tremendous amounts of bank credit growth, far above what we would expect in a typical year. So not surprisingly, we had a pretty inflationary economy, and economic growth was pretty well sustained. Now, going forward, if banks are closing down, battening down the hatches, and not making as many loans, and that doesn't bode well for the economy. There's going to be less money, less spending, and it would help accomplish the Fed's goal of dampening down economic activity and inflation. But there's always the threat of perhaps it having a bigger effect than anticipated and pushing us into a recession.
Yes, so something to watch very closely. Thank you so much for your insight on these topics. Joseph Wong, thank you. Fed guy, blogger, and monetary macro CIO. Coming up, looking at the alternatives. If the words fine art make you feel uncomfortable, you should check in with a company looking to expand this famously exclusive world. We'll talk with Artsy next.
Leadership in times of economic uncertainty, one of the critical elements is around communication, transparency, and I think it's frequent communication, and probably most important is authenticity, being authentic and having people trust that what you're telling them is accurate and enables you to lead the company or the teams through this period of uncertainty. Have not changed leadership style during this time of uncertainty. And if you add the pandemic, which was a very uncertain time for so many people, one of the things that we have seen is during this time of uncertainty, and particularly through the pandemic, people were looking for more leadership from the company and from the leaders of the company, and including taking positions and communication on things that may not be directly business related. So I've felt even more accountability and responsibility in my role as a leader as we've been going through such an uncertain period of time for so many employees. clearly, trust and confidence are really important to lead people and lead teams. And so I'm looking for those in people who can build and create trusting relationships. Collaboration is also very critical. I'd characterize it as a coaching mentality as opposed to a management mentality. Coaching means I'm investing in people to help them perform well and to be successful, to achieve their objectives, as opposed to I'm managing a group of people. So all those I think are really important. First, I'd say do what you're passionate about. Make sure that you believe in the purpose with what you're doing, because if you do that, you can do something with much more energy, enthusiasm, authenticity, and you could be that leader that people will look up to. And then the last thing I'd say in terms of recommendation is lead by example. Don't ask other people to do what you're not willing to do, and people are paying attention to what you're doing more than what you're saying.
Between economic data and the first quarter earnings season, the stock market continues to face a lot of uncertainty. But while markets might be worrisome, one could find a beneficial alternative investment path through fine art. Here to discuss this and more is Mike Steib, the CEO of IXIC. Thanks so much for being here, Mike. So this offers people a way to get into the art market here. And it's funny that we're describing the art market as potentially more stable than the stock market, because I don't think of it as more stable, but maybe you can correct that perception. Talk to me about what people can expect when they invest in art.
Well, Julia, there's probably two ways to think about it. The first is if you look at art as an investment class compared to the S&P 500, real estate, et cetera, and how it performs, especially in times of economic disruption or high inflation. A basket of post-war contemporary art that has come to the secondary market performs at significantly higher levels than stocks and other assets. So folks who are focused on art as a part of their portfolio have found that it performs well for them, especially at times like this.
But I mean, isn't that figure pretty heavily skewed towards some of the big ticket, huge sales that we hear about in auction that are not the kind of art necessarily that normal people would be investing in? Or does it perform like that sort of across the spectrum, across the price spectrum?
When you look at the performance of art, you can really only price it to market when it has come to the secondary market. And as you know, that tends to be artworks that are by notable artists that have appreciated over time. So if someone is a newer investor in art, they have two options. The first option is they can, if they've got the budget for it, they have the appetite for it, they can invest in artists who've already established a secondary market. That's the kind of art that I'm referring to when I'm giving you comparisons to the S&P 500. That's notable artists like Andy Warhol and Kusama and Kehinde Wiley and others who folks have heard of. And you can buy original works by those artists, and you can buy prints and multiples, both of which tend to have stable and consistent returns in the secondary market at a range of price points. The second is there's art investing that is more like venture capital. It's buying into artists who are earlier in their careers, who have not established a secondary market yet, being a patron and a supporter of that artist before they've hit those marks in the secondary market. And you can find significantly higher returns on a single investment, but you're going to have more beta in your portfolio, if you would, because you're making more speculative bets.
And so when you're investing in the art market, something else that's sort of quite different from the stock market is a lot is done in the shadows, so to speak. In other words, these are not public deals in many cases. A gallery might come in and make a bid for an artist to try to push up the price, for example. So what do people who are new to this need to know in that sense?
Well, the first thing I'd say, Julie, is right now, investing is not a lot of fun in a market like this. Investing in art is always fun. So the first thing I would note is you're not only walking away with 10 Class A shares of some stock when you are participating in the art market, you bring something into your life that's going to warm your home and give you endorphins and connect you to the work of an artist who's out there doing important things and speaking to the world in a way the world needs to hear it. So that, I'd say first and foremost, is something that really differentiates art investing from others, which is It's cool and it's fun and it brightens your life. But secondly, it's more fun when you do it and you do it well and you see your artworks appreciate. One of the things we worked really hard on at my company at Artsy is we bring all of this data that's historically existed in the shadows into the fore where the consumer can do their own research. We have millions and millions of secondary market transactions. So if you're looking at an artist who has an established market, you can see where they have sold in the past every time it's sold publicly. But we also have access to lots of the data that hasn't been out there before. We know all the searches and the inquiries and the saves and the follows on artists throughout their career arcs. And we share this information on our site, on the artist page, as well as through the editorial work that we do and the data science work that we publish for our audience.
How is Artsy I mean, there's been this new class of services and sites like this over the past decade or so, right? Where you can either buy a work, buy a piece of a work, et cetera. What makes Artsy different, and how are you guys trying to compete in that, what has been a more competitive market?
Artsy's different in that Artsy's comprehensive. We work with close to 4,000 of the most prestigious galleries around the world in over 100 countries. We have over 1 million works of art by artists represented by those galleries, all brought together in one place that is easy to search and sort and discover the work that's going to be interesting for you. We have artworks that are available for sale through auction. We have artworks that are available for sale at the click of a button. You also have the opportunity to communicate with the gallery if you want to get to know more about their program, more about the artist. We have an advisory team here that supports folks. We even have software that people use to manage their own collection on Artsy and track the careers of their artists once they've bought them. So while there are a lot of folks doing interesting things in the art market, I think where Artsy has especially differentiated itself is in the size and scale of what we're doing. Millions of people are on Artsy looking to buy art every single month. And the vast majority of the leading galleries and artists from around the world have their works represented in our marketplace.
Mike, thanks for being here. Mike Steib is the CEO of Artsy. Appreciate it. Thanks. Coming up, a fun one for your calendar. It's tax day, just over a week away. We've got you covered with the Yahoo Finance Ultimate Tax Guide. You shouldn't miss it. With a little over a week to go before tax day, we've got you covered with the Yahoo Finance Ultimate Tax Guide. If you need more time, you can file for an extension, but not knowing the rules can cost you big time. Here to break down everything you need to know about extension is Yahoo Finance's personal finance reporter, Rebecca Chen. So what do people need to know, Rebecca, about filing extensions?
The first and most important thing that taxpayers should know about filing extension is that it gives you extra time to file, but not extra time to pay. That means if you still have tax liability, you have to make that payment by April 18th of this year. But you could do your taxes a little bit later for the October deadline. So many taxpayers do come with this chicken or egg dilemma. If they don't know their tax liability until they do their taxes, and if they do their taxes, they wouldn't need an extension. So what many experts that we've chatted with say in this situation, they should make their best estimate and make that liability payment, because if you don't, you could be subject to penalties or interest.
Oh, interesting. And what is the easiest way to request an extension?
Fortunately, the extension process is fairly straightforward. There's really 3 ways to do this, and first 2 are electronically. You can go onto the IRS website. They have partnered with 3 tax software companies that you can do this for free. Or you can just use the tax software that you normally use to do your extension. But if you want to do the old-fashioned way, you can always print out a form from the IRS website and mail that in. We just recommend that if you do that, make sure you do a certified tracking so you know where it is and that it's reached the IRS.
Yes, that makes sense. And we're talking mostly about federal extensions here, but obviously you filed state taxes as well. Do you have to file 2 different extensions? How does this work?
It depends. It depends on which state you live in. If you live in a state that recognizes federal extension, then you don't have to do anything else. You're done. But if you live in a state that does not follow the federal extension, you will have to, such as New York, the state of New York, you would have to do a separate extension. So it's always a good idea to go on to the IRS website or the State Department Revenue website and check which bucket it falls in.
All right, all really helpful information as it comes down to the wire here, and people might want to file extensions. Our personal finance reporter, Rebecca Chen, thank you so much. Appreciate it.
Thank you.
Well, if you haven't touched your taxes yet, then guess what? You are not alone this year. More than 40% of Twitter users say they have yet to file their taxes. So, Dan, I got to ask you, what do they need to know as they're getting ready to submit?
They need to start getting moving here.
Well, yes.
I mean,
Clock's
especially if they're thinking that they're actually going to have a tax preparer available to do their tax filing, because there's a shortage of preparers. So if you're waiting until the last minute, there's actually a possibility you may not have somebody that can do this for you, meaning file an extension. We're pretty much at the point now where can people really get those returns done in time? Probably not.
Okay, so walk us through the biggest changes between last year and this year.
Sure. So I guess good news, bad news, depending on how you look at it, there aren't a lot of changes going on right now with the tax code. Why? Because Congress has been split and they haven't been able to decide on anything. So one of the things is good news. The standard deductions are larger this year. The other thing is that the tax brackets have moved. Not the rates, but the brackets have moved up, which also means a little bit more, a little bit less taxes to be paid. All right, so now there's some other things that maybe aren't such good news. So you have the child tax credit, little bit smaller this year. Also, the expansion of the child and dependent care credit expiring. So that's not good news. The earned income tax credit also smaller. There was also a deduction out there basically for everyone, up to $300 for charitable deductions. That's now disappeared. So if you want to get a deduction for any charitable contribution, you must be filing a Schedule A, which means you're taking itemized deductions, not the standard deduction.
Sure. Now, everybody knows the common deadline, April 15th. But beyond that, what other key deadlines do people need to keep in mind as they are filing?
So we get a couple extra days this year, the way the calendar works out. It's April 18th for filing your tax return. Then we have the June 15th deadline, which relates to making your next estimated tax payment for those that are required to make estimated tax payments. And then you have the extended due date for your personal tax return, which is October 16th this year. So if you're not going to make the deadline next week, file an extension. All your tax has to be paid first, though. It's not an extension for taxes, only the return. And then you can file your return on October 16th.
We know that the IRS has been going through a massive effort as well, just to bring more people on to make sure that these returns get processed through. I mean, what type of timelines are we looking at there as well? What can people expect realistically?
Well, you know, this is the government, so things take a while to get moving. Yeah, I'm going to say something that is a little bit unpopular.
Okay.
And that is the IRS does need more resources. They don't have enough people to be able to process all these returns. I know people are afraid of, oh, they're going to have more auditors. We're all going to get audited. Well, maybe some people, but we have to focus in on they don't have enough people to service the taxpayers, meaning answering questions and being able to process tax returns like your refund.
Yep.
So they are getting better, but they do need to bring on more people. I anticipate that's going to be about a 2-year cycle for them to catch up.
We had put the question to some of our Twitter followers out there and really just tried to engage them within this conversation, get a sense of what they want to know as well. One, what should I expect my taxes to look like as a new homeowner? That was one of the questions that came up from our following.
So what that question really relates to is, am I going to have enough deductions now that I'm a homeowner between your real estate taxes and your mortgage interest where it will be higher than the standard deduction? Now, the standard deduction is pretty high right now. So if you're going to exceed that because you're a homeowner, well, okay, now you're going to get some tax benefit. But if your itemized deductions, because you're a homeowner, are less than the standard deduction, then you're actually not going to get any additional tax benefits.
And then additionally here, another question that came in from our Twitter following. I love these questions. And in fact, continue to throw them onto the thread that we've got running on our poll as well here. But they say, if my office is in a state that I don't live in and I work remote, that topic of virtual employment reigns supreme right now for sure. Does that change my filing status at the end of the day? What do we know related to that?
Okay, so where you live and where you work, that's not an IRS issue. That's not a federal issue. That's a state issue. And now what you have is all these states are fighting to get more taxes. So there's actually a lot of litigation going on between the states where they're all trying to say, hey, those are our tax dollars in spite of where they live or where they work. So the answer to that is not black and white. It's actually gray. It depends which state you're living in and which state you're working in when it comes to remote work.
All right, Dan, you clearly had some good coffee here today, no doubt. Just lastly here, when we think about the number of homes that are trying to figure out, all right, what are the benefits that we can take advantage of? Where do we perhaps just need to pull in a professional to make sure that we get the best credits as well out there? And then additionally, those that are saying, all right, I have a portfolio as well that I have to account for. Perhaps that's something that we need to hit on. We've got a heavy investment audience out there too that's just wondering what some of the biggest changes in terms of some of their either capital gains or capital losses may have been in 2023, between 2022 and 2023.
You know, there's been a lot of discussions about what changes may occur, right? But we're not in that position now. However, what's complicated a lot of things from a tax standpoint for investors is crypto. A lot of that reporting has become very complicated. So you have to look at it this way. If you're not a tax expert, why wouldn't you invest those dollars to have someone do it for you? There's plenty of things I'm not an expert in, so I have to pay someone else to do it for me. Why would you want to mess around with your taxes? I really believe unless you have a super simple return, it is probably a good investment to have someone who's seasoned in preparing tax returns to do that for you.
Yeah, I know if it's anything more than changing a light bulb, I'm probably going to call an electrician. Same thing with taxes largely there. Dan Geltrude, thanks so much for taking the time here with us today.
Thank you.
Appreciate it. All right, guys, and we will keep it right here on Yahoo Finance Live. We've got much more on the other side of this short break.
+700 cars on display here. One clear theme: the EV surge is here. It's a great time to be shopping for an electric vehicle. Automakers are expected to spend over $1 trillion in the next decade to develop and deliver the next big thing in EVs. Tesla spends the most on R&D per car sold. It also sells the most EVs, taking 4 of the top 5 spots in 2022. But other companies are catching up.
We actually talk to new vehicle shoppers every single month, and we ask them, are you interested in purchasing an electric vehicle? 27% say yes, very, very likely. And the number one brand has consistently been Tesla, but the last few months we've seen Chevy overtake them in brand consideration, and Ford is right there behind them.
More choice, competitive prices, and generous government subsidies are all powering the EV market right now. But one big issue standing in the way of electric vehicle adoption: charging ports.
Now, if you've got a charging station at home, you've got a level 2 station, great, that helps a lot. We're still a little ways away from the great American road trip in an electric vehicle. You know, it's an ongoing process. Things will get better. Folks get these things at home, and then we get more and more infrastructure. The bipartisan infrastructure bill will go a long way to doing that.
California leads the way with 44,000 charging ports, more than 4 times the number 2 on the list, New York. Naturally, some of the country's least populous states, like the Dakotas, have the least amount of EV chargers. And now, even oil and gas companies are building charging stations. BP just announced a $1 billion investment in the U.S. over the next several years. Charging stations are one piece of the puzzle. Another key element for mass adoption of EVs is buy-in from car dealerships. I caught up with Mark Scheinberg, the president of the largest regional automobile dealer networks in the country and one of the organizers of the New York Auto Show. How hesitant are your dealers to making this full transition away from gas-powered?
Well, any business person, when you say, listen, you've got to invest $1 million into this, they're going to go, yeah, show me the return on investment. But dealers are like a lot of entrepreneurs. They see a business climate. They understand that this is what is coming down the pipe. They need to come, to work with it. It is a big investment on their part on it, but they do believe that, this is where the business is going to be in the future.
Big bank earnings, key inflation data, and fresh news from the Federal Reserve. We've got a huge week ahead for the markets. Here's what you need to know. The country's largest banks will report earnings next week. JP Morgan, Wells Fargo, and Citigroup all set to post their first quarter results, set against the backdrop of a possible banking crisis. Wall Street will be watching closely for performance on deposits and bank liquidity, while top executives give insight into the health of the U.S. banking system. Plus, we'll receive new inflation data and retail sales figures for the month of March. Will we see inflation continue to trend downward? All of this, of course, is being carefully considered by the Federal Reserve. Americans will pick the brains of Fed policymakers throughout the next week as we hear comments from several central bank officials and get a readout of the minutes from the March policy meeting. What does all this mean for interest rates and the stock market? We've got you covered right here at Yahoo Finance.
Well, stocks are starting the week on the back foot as recession fears and results season anticipation takes hold. The Nasdaq is leading major indices lower, perhaps on all of the above, and the market pricing firming up for a 25 basis point Fed hike in May. The growth stock heavy index is particularly sensitive to rate policy, of course, and here you're looking at the Nasdaq 100. In particular, we have a decline in Apple today on those IDC numbers about PC shipments. Tesla also taking a hit after it cut prices. And let's get a quick check on the banks as well on anticipation of those earnings we keep talking about. Not much movement in the banks as of today. Wells Fargo among the best, up 1.25%. And we are keeping the good times going on the tax front. Yahoo Finance's ultimate tax guide coverage is going to continue. Lisa Green-Lewis from TurboTax will join us tomorrow with tax tips for investors. So you want to keep tuned for that after you learned about extensions today. You can also stay tuned tomorrow for our own Jennifer Schonberger's exclusive interview with New York Fed President John Williams. That will be at 9 a.m. ET. You don't want to miss that interview either. That's it for now. I'm Julie Hyman with Brad Smith. Rochelle Akufo is going to be back at 11 a.m. tomorrow.